all of these trades right now are so sort of knife edge.
Tech is a much more nuanced sector now.
If you look at places where we've outperformed, it's been the physical over the digital.
The tactical case for a continued bounce from here is pretty strong, I would say.
We think we're going to go back to a high-quality, large-cap trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, gripped by tech anxiety, the stronger than expected jobs report failing to ignite an equity market rally as investors are pushing out the prospect of further interest rate cuts from the Fed, and a new wave of AI anxiety is beginning to spread to real estate services, from software to wealth management and now real estate.
Yesterday, CBRE and Cushman & Wakefield saw the biggest plunges that they had seen during the peak of the pandemic when the world had shut down and offices were dead. That gives you a sense of just how significant some of these drawdowns were on the fear of, guess what, disruption that would eradicate their business model. I keep going back to how can we understand if the business model is going to zero or going to a very small multiple in the very near future or in 5 years? Does it matter? How do you prove the unknown? And this is the technology that we're facing right now that poses that existential threat.
It's difficult to prove the negative. You can't sit here and say it won't happen. A lot of people think it will, or at least they're worried it will. Management teams are super frustrated about this right now. Analysts of the companies are as well, as this just cascades through financial markets one wave after another. There was a really salty quote from the team over at JP Morgan. I actually really enjoyed it. Generalist money flows responding to the rapid AI product rate of change dynamic are overwhelming the deeper thinking fundamental software sector specialists. That's the story of the last week.
And that's the reason why you've seen a lot of pushback and, frankly, a lot of buying in some of the sectors that have gotten most beaten up by these waves of AI fears that are washing through things. You know, the real question here is, how do you create a competitive moat? And you asked this question yesterday about some of the wealth management spheres. How do you create a moat around your business? Is it just to get big? Is it just to adopt some of these tools quickly enough? Is it a certain type of personnel? We don't have a clear sense because we don't have a clear sense of what the capacity of AI is going to be, not necessarily tomorrow, but say in 6 months or a year.
They're upset because they think they've already got one. What they can't do is put a moat around the stock. And that's the problem for the stock market at the moment. Futures are positive by 0.3. The next stop is the data. 8:30 Eastern Time, jobless claims following a much stronger than anticipated jobs report. But check out the reaction to the job numbers yesterday. We faded that move so fast. The numbers were really decent. And then you look at things like the Russell, lower on the session. You look at the US dollar, flat on the session. What happened yesterday?
First of all, the breadth of some of these job gains was pretty narrow. It was healthcare, first and foremost, which isn't necessarily a statement on the roaring exuberance in the economy. Then you look at the downward revisions, and then you start to look at some of these seasonal aspects that come together, as TD Securities said, in a perfect storm that gave a really good look to this payrolls report. People kind of shrugged it off and said, let's see what next month brings, because ultimately this isn't necessarily giving us confidence that we're not necessarily just out of the woods, but that we're actually on a reacceleration path.
So next hour, got a fantastic lineup this morning, but next hour, David Tinsley of Bank of America on the Bank of America Institute Consumer Checkpoint report. So we've talked a long, long time about the K-shaped economy. Low income versus high income great, low income really struggling. Middle income and the gap between middle and the top starting to open out. That is of concern, and that's something David will talk to a little bit later.
You know what's a really good example of that? LVMH and Gucci versus Hermes. LVMH and Gucci catered increasingly to the middle class, the aspirational buyer, and they are getting hammered because they are losing market share. Hermes, with your $10,000 Birkin bags, crushing it and able to raise prices, and that gives you a perfect example of where some of the pain is really bleeding into.
And McDonald's leaning into value, capturing the trade down from the middle to the low income.
They dropped prices last year by more than 15% on a slew of items in order to drive traffic, and they saw that. This is similar to Pepsi. They see a similar type of environment taking place this year, even as that Birkin bag is getting more expensive.
Yeah, that Birkin bag was never on my radar anyway.
To be fair, it was never on mine either.
Equity futures on the S&P 500 positive by 0.3%. Coming up this hour, Julian and Emanuel of Evercore as markets shrug off stronger than expected economic data. Sharon of Goldman Sachs with European equities quietly outperforming, and the Republican Congressman French Hill as the divide widens on Capitol Hill over tariffs. We begin this hour with stocks on the brink of fresh all-time highs. Julian and Emanuel of Evercore writing, although valuations remain extended and market leadership is in flux, the hallmarks of the end of a bull market are not present. Julian joins us now for more. Julian, good morning.
Good morning.
What are the ingredients needed for the end of a bull market?
So the first is signs of a recession. That is the most typical top. And, you know, as choppy as the data is and as much of the negatives that you can unpack, you know, the fact is we had a strong jobs report. And then the others would be either a Fed hiking rates, which no way, no how, no set of economic data will that happen prior to the midterms at the very earliest. Pressure on the long end. I mean, I think as investors, maybe the biggest surprise is how incredibly sedate U.S. 10-year yields have been when the rest of the world's yields have been exploding higher for months and months now. And then, of course, the last one, and the one that we think is going to be seen at some point in this cycle, is really true investor FOMO driving, you know, palpable overvaluation, along with a very substantial capital market surge. And from our point of view, the FOMO over the last 2 months has been anywhere but stocks. It's been in gold and silver, and you see what's happened to gold and silver in the last several weeks.
Well, let's focus on stocks. Is there some FOMO in staples?
It's extraordinary. It's absolutely extraordinary. And if you think about year to date, value outperforming, which isn't necessarily a positive look on a go-forward basis for markets. Staples screaming higher, and I would characterize it as FOMO, particularly when you see, you know, snack food price cuts in front of the Super Bowl driving stocks markedly higher. You know, good on them. But also financials underperforming at the same time. Extraordinary. That message tends to say recession ahead, but actually there's a much more nuanced story. It is really a manifestation of this AI disruption trade.
That's the place to hide. Staples.
It is. So when we started coverage on AI almost 3 years ago now, has it really been 3 years? It seems like a century. We took every industry, every company, every job, and parsed it along these vectors about where, what jobs and what industries were most likely to be disrupted. We all knew several years ago software was among the highest. Well, look what's happened to software. The legal profession, but also the financial profession. And lo and behold, you look at year to date, those are the ones that are getting hurt the most performance-wise. But on the other side of the ledger, the ones likely to be least disrupted, metals and mining, agriculture, and you know, consumer staples, services not far behind. The winners.
Do you want to hide from the disruption, or do you want to chase it? Do you want to chase the sell-off? Go into some of these stocks that have gotten beaten up and say, you guys are throwing the baby out with the bathwater?
In our mind, it's getting overdone. We are inclined to dip our toes. And again, remember, when you're doing things that are counter to the trend, you have to be careful, you have to be disciplined, you have to be prepared to have a battle plan and maybe add on weakness. But from our mind, you know, we do think in areas like software, in areas where, you know, lots of stocks have heavy short interest, you do want to dip your toe in.
As an investor, how do you prove, to John's point earlier, counterfactual? I mean, how do you even begin to assess what the actual risk is now and what it could be in 6 months, and then come up with some sort of business model and an understanding of what that moat looks like?
Well, it's incredibly difficult, and it explains why, first off, if you look at the start of this bull market in October of 2022, the only two sectors that have outperformed the S&P 500 have been communication services and information technology, the place where the hyperscalers reside, the place where AI Central is located. So that explains part of the bifurcation. But in my mind, a lot of it is just, you know, this whole idea of the embrace of AI and the potential for it to transform. And we do not believe that AI is a discrete job killer. We think it augments, it transforms jobs, and we're living it at Evercore ISI.
So what's gripping us right now? Do you think this is just the Anthropic roadshow? Just the big enthusiasm ahead of the IPO a little bit later this year and all the headlines just to entice some attention? Well,
look, we saw these roadshows throughout 1999 and into 2000, and they were real. And when the stocks came out, and this speaks to actually the greater rationality that we're seeing in capital markets now, think about it from the credit side, high-yield technology credits have widened dramatically because there's a chance that there won't be survivors of the smaller. Investment-grade credits, you just had a 100-year bond issued.
Eaten up.
The last time that happened was 1997 in the height of the technology boom. And guess what? The NASDAQ rallied another 400% before the top.
So let's talk about the index level stuff. The year-end median forecast in our survey here at Bloomberg for the S&P 500 is something close to 7,600. How do we get 10% upside at the index level, market cap weighted, without tech regaining leadership?
You can't. Full stop. And to be clear, we are very heartened by the embrasure of this rotation. It's very normal in the start of the new year for the laggards to outperform, but the math at 54% of the weight among communication services, consumer discretionary, and infotech means you got to lead with the date that you brought to the prom in the first place.
Which is tech. Julian is going to stick with us. Julian Emanuel there of Evercore. The equity market at the moment positive by 1/3 of 1% on the S&P. If you strip out the muscle of tech and focus on the equal weight, 4 consecutive days of gains. All-time highs.
And partly it's because people are hiding out in some of the consumer staples and some of these other areas that are physical, tangible goods that you cannot replace with a computer.
Let's get you an update on news worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. U.S. Energy Secretary Christopher Wright says Washington can help Venezuela raise its oil, gas and electricity output this year. Speaking in Caracas, Wright said the Trump administration will issue new licenses for businesses to buy Venezuelan products and invest in its economy. Wright is the most senior U.S. official to make a public visit since the capture of Nicolas Maduro. The Fed signaling plans to abandon some of the confidential warnings it previously sent to banks to improve operations. Sources telling us here at Bloomberg the remaining flags will focus more on immediate risks to a bank's financial health and less on processes and procedures. Banks have argued that Fed supervision has become too complex and expensive. Apple's long-planned upgrade to Siri has run into snags during recent tests. Sources telling us Apple is now working to spread the improvements across future versions instead of in an operating system upgrade slated for next month. Testing has found Siri cannot properly process queries, takes too long to handle requests, and faces accuracy issues. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie later. Appreciate the update as well on Venezuela. Annmarie on the ground at Caracas. Isn't that just the most Annmarie thing ever? To go to Venezuela?
If there is a sort of unstable land that seems full of conflict and potential for violence, Annmarie is there.
My mum messaged me and she said, "Where's Annmarie?" And I said, "Venezuela." And she said, "Vacation."
Yeah.
It's like vacation.
For her it is.
Maybe for Annmarie.
You know, it gives you that zip, that vigor.
Hopefully we catch up with her going into the weekend. Up next on the program, challenging Trump's tariffs.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Next up for the data later on this morning, 8:30 Eastern Time, jobless claims in focus following a very, very good payrolls report and upside surprise payrolls, rising the most in more than a year. Emphasis matters here. Where do you put the emphasis? On the green shoots in manufacturing jobs or the fact that healthcare is still doing all the heavy lifting, adding the most jobs since 2020?
problem is you have to kind of include both points, which is the reason why I really was struck by what TD Securities had to say, that maybe we're no longer at risk of a major downdraft in the overall economy. But this isn't a screaming recovery that really speaks to some of the exuberance that people were talking about. So that's the uncomfortable middle ground that's incredibly unsatisfying and inconclusive that I can give you this morning.
Do we see some signs of stabilisation? Maybe we do over the past few months. I hope we do. I hope we see more of the same a little bit later this morning when we get jobless claims. Equity futures on the S&P positive by a third of 1%, on the Nasdaq up by 0.27, and there's your outperformance once again on the Russell. It resumes higher by 0.57%. Other Savannah's this morning challenging Trump's tariffs.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs. So we're doing numbers that nobody thought were possible. 78% reduction in our trade deficit. And next year, we're going to be positive if we keep it all going.
So here's the latest this morning. 6 House Republicans crossing party lines, voting to block some of President Trump's tariffs on Canada. The president responding in a post on Truth Social, writing, any Republican that votes against tariffs will suffer serious consequences come election time. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the programme. The pressure starting to build down in Washington.
It definitely is, John. I mean, this marks the starkest political pushback that we've seen yet to one of President Trump's signature economic policies as we head into the midterms. Now, to be sure, this measure next has to go to the Senate, where it actually really likely could pass. But President Trump is going to veto any such measure, and then it would take 2/3 majority in Congress to override his veto. So this type of legislation is probably not going to become law, but it underscores that mounting pressure as Republicans are playing defense, according to polling, on the top issue for voters, which is, of course, the economy. And it's really interesting when you look at the 6 Republicans that voted against the president here, because they represent different factions of the party. Some are, yes, retiring, but others have long been feuding with President Trump over his agenda. Some are citing specific concerns for their states, like one lawmaker in Washington talking about how cross-border traffic has declined when it comes to the tariffs with Canada. And then others are in some really critical primaries in California, in Pennsylvania, where they represent battleground districts. And when it comes to the time for November's election, they're going to have to appeal to that broader voter base. Now, one thing's for sure, President Trump is not going to support any of these candidates in the primary. You read part of his post on Truth Social there, where he is threatening these consequences, and he could follow through. We have to keep in mind he has an unprecedented $483 million war chest that he has amassed and that he is going to use when it comes to targeting some of these lawmakers. Now, John, overall here, we have to keep in mind this specific measure is targeting Canada. Comes at an interesting time, of course, quite timing as the U.S. and Canada escalate tensions. Bloomberg News reporting yesterday President Trump is privately mulling exiting the USMCA, but this is going to be the first in what is expected to be a series of votes. We're expecting the next one later this month. That's going to target Mexico's tariffs in particular.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Middle-income workers are being squeezed. And obviously, the individuals that are in a race for the midterms are being squeezed as well. Is there enough runway? The US economy is a super tanker. You're not going to change it overnight. These problems aren't going to go away. But can they improve over the next 9 months?
Well, tariffs is the number one way that they could improve pretty quickly. And that's the reason why this is the target. And that's the reason why I wonder how much some of these lawmakers are going to be cowed by the threats that we heard from President Trump.
Julian Emanuel of Evercore RSI still with us around the table. Julian, tariffs were last year's story. And it wasn't all year. It was a heartbeat in April. Does it come back on the table this year?
So it is not going to go away completely, okay? Remember, we have an April meeting out there with Xi in China, and the subtext is going to be tariffs. We've had overtures and friction with Mark Carney, and obviously, seemingly better relationships with Sheinbaum in Mexico. But this is going to be a persistent story. Now, what's happened is, again, as we've seen time and time throughout not just this bull market, but through our generations, is that corporate America has become very adept at dealing with the problem, whether it's, some pass-through, some diversion of supply chains, or just eating a little bit at the margin. The fact is that tariffs, and this is part of why the market has been rallying as relentlessly as it has, have become a lesser issue not a disappearing issue, but a lesser issue than we all thought a year ago.
So markets shouldn't have feelings, but investors do. And when we were in Davos, Switzerland, the Europeans were clearly offended by some of the language being used about the continent and the approach of this administration. When you speak to investors outside of the US, this was the only game in town. And in many ways, it still is. Some of the names listed on the S&P 500. But are you sensing an aversion to investing that additional dollar, that additional pound, additional euro in US equities?
So I think the reality is, the two things have driven the overweight over the last decade in US equities. Number one, the lead pole position in the technology revolution, which has only accelerated since ChatGPT came to the public fore. And number two, very importantly, a persistently strengthening dollar. Okay, that ended a year ago. We think there's further dollar weakness. We think this is a long-tailed, multi-year phenomenon. And from that perspective, it's sort of rational to gently rebalance one's portfolio. Again, one of the reasons that the Japanese Nikkei 225, despite soaring yields, or perhaps because of soaring yields, has rallied as it has. We think that this is going to go on for a while, but we don't think the next really intense episode of rebalancing, like we saw in the first quarter of last year, happens until the AI trade reaches a crescendo, which we think is still well off into the future.
Some of what you're saying echoes what George Saravelos of Deutsche Bank wrote in a note yesterday, that he called the safe haven myth. And he talked about how increasingly dollar exposure hasn't been an offset to a risk-off move. And as a result, the less attractive the dollar is as a portfolio hedge, the more incentive there is to reduce dollar exposure. Is that kind of the dynamic that you see out there right now?
Well, and if you think about it, what's been very curious about the last year in particular is how correlations amongst assets have been shifting intensely. Take the metals, for example. Last year at this time and into the middle of the year, it was like, how can it be that gold and the S&P 500 are both going up in lockstep? Who knows? It must be something systemic. And then it was like gold is going parabolic. There must be a problem with the S&P 500. And over the last month or so, it's gold and silver crashing. There must be a problem with the S&P 500. Well, guess what? There isn't. It's just a world that continues to be having the good problem of so much liquidity.
The liquidity right now is shifting, and it's not shifting away from the U.S. It's just going more intensely toward Asia. And you see the Asian equity markets outperforming at the fastest pace to start a year, going back to at least 2000 in some of the data that we're looking at. I'm just wondering, is this a sign that people view big tech as in Asia as taking the lead right now over big tech in the United States?
Well, and part of the discomfort people have had with the S&P 500 is 40+% of the weight in 10 stocks. Well, guess what? Go to Korea, and you're getting close to 50% of the weight in 2 stocks.
2 stocks.
Yeah, but that is a manifestation, again, in our mind, of the secular importance of the AI revolution.
Julian, it's good to see you, breaking it down. Thank you, sir. Julian Emanuel there of Evercore and the AI disruption and division we're seeing in the equity market. The FX piece of this is so important. It was win-win for the foreign investor. You've got the price appreciation off the back of the dominance of US tech, and then on the drawdown, you've got the dollar appreciation that was the natural hedge. So you just took the exposure on the equity side and on the currency side. And now you're starting to question that. And if you're a domestic investor in, say, the UK or Europe, it's a different decision to make at the moment.
Yeah, and this is a reason why I found George Saravelos' note so interesting. And it's not necessarily that no longer is this a haven status or reserve currency. It's that ultimately it isn't going to offer that hedge, that portfolio hedge. And right now everybody wants to find a portfolio hedge. To Julian's point, there ain't one. And that's what it seems like increasingly, except for maybe some physical assets that you're going to hold for a long time. But that's the dirty secret. And so it doesn't send everybody to the same place to get that kind of offset.
So the word you'll hear all the time, diversification. And I know it's frustrating because it sounds so cliche sometimes, but you're about to hear it again repeatedly throughout this year.
Diversification means what, though, right? Diversification of locations, diversification of industries, diversification of vulnerabilities to AI disruption. It means a lot of different things. It's not easy, and people don't like not easy things, but here we are.
Just hide in staples.
Yeah, exactly.
Seems to be the
until
story
it's
at the
overpriced.
Yeah.
And then go back into software.
Some people think we're already there. Coming up on the programme, Sharon of Goldman on the state of the Sal America trade, plus Yahaira has your morning movers. Shares of Cisco falling as higher memory costs weigh on the company's outlook. That stock is down by almost 8%. 2 days, no gains on the S&P 500 this morning. We're looking to change that, up by 1/3 on the S&P. A stronger than expected payrolls report failing to ignite a market cap index rally on the S&P 500. But the equal weight keeps doing what the equal weight's been doing through most of this year. 4 days of gains and all-time highs. Futures up across the board this morning. The Nasdaq higher by 0.3. Outperformance on the Russell higher by 0.6. With an update on some single names, your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing Cisco shares under pressure this morning, down 7.5% after it became the latest company to warn that rising prices on memory chips will eat into profits this quarter. That matters because Cisco is the world's largest maker of networking equipment, and it uses those components across a wide range of products. That overshadowing what was otherwise a solid report, with the sales outlook coming in strong due to Cisco's role in the AI build-out. Meanwhile, moving on to App 11, the sell-off here catching some analysts off guard because it posted a better-than-expected outlook, beat earnings, and yet the stock is down 5.3%. Some on Wall Street calling this a clearing event, so basically strong results, but not strong enough to clear up the bigger debate with concerns over AI disrupting software still hanging over the story. And we end on Fastly. This is a company that makes the behind-the-scenes technology that speeds up online content. Shares are ripping higher after it gave a blockbuster outlook for 2026. It expects earnings to be double what analysts had expected. So it is the top gainer on the Nasdaq this morning and up 40%. John.
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, President Trump's tariff policy suffering their strongest political blow so far. 6 Republicans crossing the aisle to pass legislation rejecting levies on Canadian goods as concerns mount on Capitol Hill over the upcoming midterms. Elsewhere, real estate service stocks plunging by the most since 2020, becoming the latest sector hit by widespread AI fears. Investors remaining wary of companies potentially vulnerable to new AI tools that could accelerate automation. And finally, turning to energy, the Trump administration making a special trip to Venezuela as the United States looks to strike a deal on the largest oil reserves in the world. Energy Secretary Chris Wright saying U.S. plans for Venezuela's crude will benefit both countries.
We can drive a dramatic increase in Venezuelan oil production, in Venezuelan natural gas production, in Venezuelan electricity production. All of these are to increase the job opportunities, the wages, and the quality of life for all of the Venezuelans.
Annmarie back on tour. She joins us now from Caracas for more. Annmarie, just describe what you've seen in the last 24 hours.
Well, it's been almost surreal being on this trip, Jonathan. Of course, we're in Caracas, Venezuela, a country, a city where the leader was captured by U.S. forces at the start of the year. And then some 5 weeks later, we touched down. The first time we've seen the highest ranking U.S. government official come to this country. The hype on the ground, people are comparing this to when the U.S. left in 2019, when the embassy, they decided to close their diplomatic overtures here. And also someone else was telling me they were comparing it to when Bill Clinton last came to this country in 1997, of course, the year before Hugo Chavez took over. So it's been quite a surreal experience. There's lots of consternation and trepidation, of course, in the business community about what can actually be achieved. They want to see stability on the ground. They want to make sure that potentially there are discussions about restructuring their debt. A company like ConocoPhillips, will they be paid back for the losses they took in this country? Secretary Wright says all of these conversations are on the table. And when he describes these meetings, and he spent a lot of time yesterday at the palace with the president, interim president, Delcy Rodriguez, he said that he wants to lift the Venezuelan people. He wants to let them free and their economy free. And he says the way to transform this country is through commerce, not through troops on the ground. And that was a message he brought himself from President Trump, who he dined with before he landed here in Venezuela, Jonathan.
Annmarie, I hear a siren behind you, and I think some of the tangibles of the experience of being down there are all the more interesting at a time where business is understanding exactly what you said, how much security there is on the ground. What's the environment like? What's the reception to some of the U.S. officials who are there from the rank and file in Venezuela?
Well, a lot of this is, as I've overheard one official talking, nothing will be in a straight line when it comes to the end destination for potentially this bilateral relationship and what the business community can expect. Obviously, there are immense safety concerns, but I was talking to individuals last night who said actually they feel that the country has been more stable in the past few years than many would have potentially remembered decades ago when they decided to leave the country. Now, if you are a company like Chevron, and today we will be going to visit Chevron PDVSA joint venture oil fields with Secretary Wright, potentially even interim President Delcy Rodriguez will be joining us. If you're already on the ground, you're going to be the ones that are able to quickly ramp up, say, production or put more investment into this country. When it comes to the businesses that are on the sidelines right now, and I'm talking to individuals from the embassy that are trying to restart the embassy here, who, by the way, the embassy actually has mold in it because it was left after 2019, they're getting a tremendous amount of outreach, they say, from everyone in the United States, from C-suite America, from Washington, D.C., that want to be the first ones on the ground. Being the first ones on the ground, coming here and seeing what the situation is, though, is very different from making a massive capital investment. And that is really the question lies for the future of this country and how much business and capital and financial interest it can draw.
Annmarie, fantastic work, and looking forward to your conversation with the Energy Secretary, Chris Wright, a little bit later on today. That's coming up on Bloomberg TV and on Bloomberg Radio. Annmarie on the ground in Caracas, Venezuela, after some big changes in that country over the past month or so.
The idea that suddenly the leader, Maduro, could just be plucked out, brought to the United States and make it work because suddenly this is going to be a very different country. Interesting, Delcy Rodriguez and her role in all of this, considering that she worked for Nicolas Maduro and actually was part of that administration, how much she actually is welcoming the U.S. to come in with some of the oil majors.
I'm not sure she's got a choice.
Well, that's
at the
correct.
moment. Yeah.
But how much is she actually full throttle ahead and how much she can get popular support online? That's going to be really interesting.
Should we talk to Goldman about buying stocks in Venezuela?
I think that's obvious,
that's not what
an
Goldman
obvious
wants to do.
transition.
Let's talk about European equities climbing to fresh record highs. The stock 600 outperforming the S&P 500 so far this year. Sharon of Goldman Sachs writing, the search for insulation from AI disruption risk has accelerated the ongoing cyclical rally in the US. We continue to see rising allocations to Europe as a diversifier with reasonable valuation. Sharon joins us now for more. Sharon, welcome to the programme. Let's just build on what you've just written there. The idea that Europeans are starting to look at home again. Are Americans looking abroad? Are they participating in this?
I think it's both. In fact, I would say it's more American investors, US dollar-based investors, that are worried that the US market looks expensive. They're very concentrated in their positions in the US dollar. You've got 4 or 5 companies which are all big bets on one thing, AI. So that may pay off, but you don't know. And it just leaves you with some risks. So people wanting to diversify, including US investors, but domestic investors too. Both have been buying Europe this year.
Sharon, apart from just being European, what is the diversification in Europe? What does it offer?
Yeah, offers very different sector exposure, I would say. I mean, there is a tech sector, obviously, in Europe, but it's much smaller than the sector in the US. You don't have the large hyperscalers, not spending as much in the way that the hyperscalers are in the US. So very different from a tech sector perspective. But also, and I think this is more important, Europe offers things like much more exposure to, as a share of the index, to commodity-related areas, materials, industrials, financials, which have all in the last year performed very well.
Yeah, I'm thinking about Glencore, for example, or Shell, or some of the big banks that have also done pretty well in the region. I just am curious, though, if someone is looking internationally and they're not from Europe, why not go to Asia? What is the draw to Europe that has better exposures that's going to somehow outperform at a time when there's a real kind of question around how much they can break out from some of the crosswinds coming from both the U.S. and China?
Absolutely, and I agree with that. Our philosophy has been you want to broaden your exposure and diversify, not just into Europe, but into Asia, into emerging markets. We've just upped our emerging market targets, for example. So, and actually, Asia and emerging markets have seen better earnings performance this year and have performed extremely well, better than Europe and the US stock market. So I think there's plenty of opportunity globally to diversify, including Europe, as part of that as well. But I do agree there are headwinds for Europe. I mean, economic growth is slower in Europe than elsewhere, although it's still positive and it's been boosted, obviously, by the fiscal spend in Germany. But yes, there are headwinds, such as China competition, although I do think European policymakers are starting to acknowledge this now.
You know, we're talking about the motivation, and we talk about the Sell America trade, which has become cliche. It feels like a little bit different than that, and that's the reason why we keep going back to this George Saravelos of Deutsche Bank note, where he's talking about the loss of safe haven status for the dollar, not necessarily in the sense that it's going to go to zero, but you're not getting the same diversification feature in terms of the dollar outperforming when risk assets sell off. How much do you see that as a driver, not just people wanting to look home or some of the emotions of the moment?
Yeah, I think it's definitely that there's often when you see a change in trend, there isn't one single driver of it. There's several drivers. I think we talked about the diversification sector exposure. I mentioned valuation differences, but I also think concern about having all your exposure in dollars and wanting to diversify that is also another element of this. And the euro, sterling, Swiss franc provides different currency exposure as well. So I think there's many elements to this desire for global investors to diversify and broaden out their exposures.
There's a lot of anticipation about how much money is going to be spent on AI and the beneficiaries of that, Sharon, as you know. It's a big thing for the year ahead as well, with $650 billion of capex coming from just 4 companies, which is just absolutely absurd. People are thinking about the miners, Sharon, in a much bigger way. And when I think about miners, I think about the FTSE and some of the listings for UK equities. Are you seeing that generate some bigger returns for large cap UK?
Absolutely. FTSE 100 has done extremely well this year. Index targets have generally been raised. I think, in honesty, it's an index which has been ignored for 10 or 15 years by global investors and domestic UK investors. Doesn't really have very much tech exposure. It's got a very different type of exposure, but that's actually doing quite well at the moment. It's also an index which looks relatively inexpensive. So the UK market still trades at 13.5 times PE, which is not quite half what the S&P trades on, but not far off.
Sharon Bell of Goldman Sachs. Sharon, appreciate the insight and the different character coming from European equities on offer for people looking to diversify. Guy Johnson would often call UK equities Jurassic Park. Now, that used to be a bad thing, and now it's a good thing, because that's what people want to buy into.
Honestly, Jurassic Park has shown the stability of time, right? It has proven the test of time in that we still go and talk about Jurassic Park. And guess what? Those dinosaur bones and bodies created oil that we're now using for financing all of our AI. So look, we're looking at all of this, and it's sort of what's old is new again. And we have to invest in real things, because if it's on a computer, there is a high likelihood it will be disrupted, and that scares people.
Futures right now positive by 0.3%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. McDonald's U.S. growth hitting a 2-year high. The fast food chain reporting fourth quarter earnings and revenue that beat estimates. A focus on affordability, helping to boost traffic as diners spend more per visit. McDonald's is planning to introduce new beverages this year, including refreshers, energy beverages, and crafted sodas. The U.S. and Japan are closing in on the first 3 projects funded by Tokyo's $550 billion investment package as part of a bilateral trade deal. Sources telling us here at Bloomberg all 3 projects are related to a data center infrastructure project led by SoftBank. Discussions between U.S. Commerce Secretary Howard Lutnick and Japan's trade minister aim to finalize details this week. Morgan Stanley CEO Ted Pick getting a big raise. The company boosting his pay by 32% to $45 million for 2025 after a record year for the company. Morgan Stanley shares surged more than 40% last year, far surpassing the strength of the S&P 500. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, President Trump defending his agenda.
Tariffs are bringing us hundreds of billions of dollars. Without tariffs, this country would be in such trouble, as they were for many years. Every prediction the critics made about our tariff policy has failed to materialize.
Some pushback on Capitol Hill. We'll catch up with the Republican Congressman French Hill next from New York City. You're watching Bloomberg TV. Stocks are up by 0.3% on the S&P, on the Nasdaq up by 0.23 on the Russell. Outperformance on the small caps up by 0.58. If we switch at the board and get to the bond market, repricing at the front end of the curve, 2-year yields higher, following stronger than expected payrolls numbers yesterday. The 2-year this morning at 350 57. Some commentary from Wall Street, from Bank of America. That jobs report vindicates our view that the Fed won't cut under Powell. BNP Paribas and Andrew Husby going even further. We think the Fed will be cautious on delivering further rate cuts, quote, which aligns with our base case of no cuts through 2027. That's the call from BNP.
Which is essentially validating what we heard from Torsten Slot, because no cuts for the entirety of 2026 would mean that you're continually kicking the can down the road of potential rate cuts. I just wonder about the Morgan Stanleys and the Citigroups of the world that are reiterating their calls for 3 rate cuts this year on less inflation. How high is that bar for inflation to come down now in order for the Fed to make a move?
Kevin Walsh will be under pressure, won't he? 18 months into the job, no rate cuts?
I think he's already under pressure. He hasn't even gotten the job. So you've got a good point there.
Let's head down to Washington. Under surveillance this morning, President Trump defending his agenda.
We're getting rich because of tariffs, by the way. I hope everyone understands that. Tariffs are bringing us hundreds of billions of dollars. Without tariffs, this country would be in such trouble, as they were for many years. Every prediction the critics made about our tariff policy has failed to materialize. 78% reduction in our trade deficit, and next year we're going to be positive if we keep it all going.
So here's the latest this morning. The president threatening House Republicans taking a stand against his tariff agenda. The president posting on Truth Social, there will be consequences after 6 GOP lawmakers crossed party lines to rebuke the president's levies on Canada. The Republican Congressman French Hill voting against the measure to override President Trump's tariffs, and he joins us now for more. Congressman Hill, welcome to the program, sir. Your reaction to what happened on the Hill yesterday and why you voted the way you did?
Well, good morning, Jonathan. Look, I think we should handle the tariff discussion in a more comprehensive way and not take votes every week on the floor that turns the House floor over to the Democratic Party. That's why I believe that standing with Speaker Mike Johnson on this maintains Republican control of the floor. So this is a very important strategic issue in a parliamentary body like Congress with a very narrow majority. What we should be doing about trade is urging the president to renew USMCA with Canada and Mexico, which is under review for its 5-year review this summer. It's a very important trade arrangement for the 3 countries. Progress is being made in working with the Canadians and the Mexicans. So that's number one. It's not to be connected, in my judgment, to the vote last night, which is, did the president have the right to put tariffs on Canada under IEEPA because of the fentanyl matter? You get my point. Let's stick with the big picture here, which is growing America's exports, growing America's influence, using tariffs as a tool to change trade behavior of other nations. Number one on that list, of course, is China.
Congressman, you mentioned USMCA. Our team down in Washington, I'm sure you're familiar with the work of Josh Wingrove, wrote just yesterday that the president is privately musing about exiting the North American Trade Pact. That, according to people familiar with the matter. When you read a story like that, do you just consider that part of the negotiation for the upcoming negotiations, or does that concern you?
Yeah. No, I do, because of the way President Trump is responsible for dramatically improving the North American Free Trade Agreement from the 1992-1993 timeframe in creating USMCA in his first term, and it worked quite well. But there's more to be done on Canadians on dairy or Canadians on softwood lumber, or how the automotive business works back and forth between the 2 countries, or now the role of IT. We live in an ever-changing economy with ever-changing priorities, but let's face the reality that 30% of GDP in my home state of Arkansas is connected to cross-border trade with Mexico and Canada. So the agreement is important, and it's also important for you to note in that comment that President Trump has, does not impose additional tariffs on USMCA compliant goods. So we are living by the agreement.
Congressman, there's a trade-off here, and I think a lot of people would be sympathetic with the idea of trying to get certain trade partners to change behaviors, and thinking particularly of China. On the other hand, there's a real affordability crisis, and this is a real issue for a whole host of representatives who are coming up for election later this year. I just wonder how much influence you think that Republicans on the Hill have over President Trump's negotiations around tariffs to potentially either abstain from putting additional ones on or rolling some of the existing ones back.
Well, what you've seen him do is fine-tune the efforts with individual countries or regions like the EU, UK, Japan, for example. I want to see the consolidate the wins from those. agreements that he's done over this first year in the first place. Secondly, you've seen him roll back some tariffs on commodities that we don't make here in the United States, but we need to use, whether it's a fruit or vegetable or a coffee, for example. And I think that makes sense. You don't want to burden the consumer as you're attempting to change trade policies in other countries or compel them to follow Americans' lead on something like transnational drug cartel, countering those drug cartels. But on the affordability side, Lisa, I think the most important thing we can do is stay focused on the supply side. The One Big Beautiful Bill last year, signed into law by President Trump, will see real wage increases this year for American families. In Arkansas, we expect some $10,000 in benefit to a family of four from the increased child tax credit, the lower taxes on tips, the use of the standard deduction, lower taxes on seniors' Social Security. Yeah. So on that supply side, combined with what we're doing on regulations and the proposal I made for housing in the 21st Century Housing Act, we got 390 votes on the House floor for that this week.
I personally would like to boost consumption by taking a flight to a number of places in the next week, and I'm just wondering if TSA is going to be in operation. Is the government going to shut down tomorrow night, Congressman?
Oh, Lisa, I hope not. I just look. It was so hard on my TSA agents in Little Rock and up in the tower at Little Rock National Airport, the air traffic controllers. That was a bad 42 days. That's not how to run the government. President Trump has used Tom Homan as a leader to consolidate both ICE and CBP operations in Minneapolis, bring transparency to the operation, streamline it, make sure the training is in place, make sure the operation is consistent with federal law. They're using body cams. Let's take that as the right direction and keep our government funded in Homeland Security. So important to so many people.
Congressman, it just feels messy down in Washington, but you pointed out the Housing for the 21st Century Act. We can get things done. We can find support on both sides. Congressman, what was actually achieved down in Washington, and how important is that to you?
Well, it's very important. You know, Jonathan, on the priorities I've had to have conservative center-right policy on redirecting regulation and policy for people's investment opportunities, more crowdfunding, more public offerings, community banking, making community banking great again by lowering the regulatory burden on small banks that make 60% of the home loans in this country. And now 21st Century Housing, we got 300 votes for those policies, as we did for our digital assets and crypto work last year. That shows that Republicans and Democrats, when it comes to economic policy, can get on the same page and pass legislation that President Trump should sign into law that will make people's lives better. Costs will be brought down, supply side capital will advance, and community banking will thrive in this country. And those are all good things.
Final question, Congressman. I've got about 20 seconds. Are you happy you don't have to chair the House Judiciary Committee? Because that was wild yesterday.
Well, I had a pretty wild hearing last week with my ranking member and Mr. Besant's testimony. So I know wild, but it was. But that's what happens on Capitol Hill. We bring the public and their elected representatives together to try to find solutions, and it can get spicy sometimes.
Congressman, appreciate your time. Thank you, sir. Congressman French Hill, thank you, sir, down in Washington, D.C. Serious topic yesterday in front of that committee, and things got very rowdy very quickly.
Well, this seems to be a theme, because you're right. They had the Scott Bessent hearing in the prior week, and it was just as spicy. There's a lot of animosity, and there's a lot of anger, and you could feel that emotion down in Washington, D.C.
Without a doubt. Coming up on the programme, we'll catch up with Kristen Bidley of Citi, Monica Guerra of Morgan Stanley, David Tinsley of Bank of America, Steve Ricchiuto of Mizuho. The second hour of Bloomberg Surveillance up next.
If the data continues like we see, we're not going to get to that rate cut.
The Fed probably won't see the need to do too much more.
The bigger issues are the macroeconomic conditions of the consumer.
Rate cuts, if and when they come, will be based on inflation.
The data will lead the Federal Reserve.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 firmer by 1/3% on the Nasdaq, up by 0.3. Outperformance on the Russell, up by 0.6. That outperformance yesterday didn't hold. It didn't stick. The Russell actually ended the session lower, even with stronger than expected payrolls data. Bond yields at the front end repricing higher, pushing out Fed rate cuts. Twos above 350. Yields just about unchanged on the session. Going into this, 90 minutes away, 8:30 Eastern Time. Another read on the labour market. Jobless claims in focus.
It might take on a little bit more import simply because it was inconclusive yesterday. Yes, the headline number came in better than expected, blew away expectations, 130,000. At the same time, under the hood, downward revisions. Also, you've got some seasonal effects, and people poked holes, not in that this was a good number. This was a good number, but in that it showed a reacceleration in the U.S. economy that was required to get the likes of small caps reignited.
And the Hawks are starting to feel good.
Exactly.
After questioning their stance at the back end of last week, they're feeling good. The Cleveland Fed President Beth Hammack this week, based on my forecast, we could be on hold for quite some time. Over in Kansas, President Jeff Schmidt, further rate cuts risk allowing high inflation to persist even longer.
Which is a reason why you've got a number of Wall Street firms saying forget about it for any kind of rate cut in 2026. Others, whether it's Morgan Stanley or whether it's Citigroup, talking about a potential for 3 rate cuts this year. How much are those rate cuts necessary for some of the more cyclical areas to get reignited? Ultimately, it depends on what the data show and how much can we really say that a Kevin Warsh Fed is not going to cut rates. And that is a political discussion that a lot of people will say has been answered for us.
So I have exactly the same response to all of this. When BNP Paribas come out and say no rate cuts through 2027, that is no longer just an economic assessment. You're making an assessment about a new Fed chair selected by the president almost exclusively to cut interest rates. And you're making the forecast that in their first 18 months on the job, they won't reduce interest rates?
This goes to the question of how much control they have and whether they can influence a Fed committee to cut rates if the data shows a good degree of growth. What that forecast sets up to me is a massive battle and a tirade going on Truth Social about what potentially should be happening at the Federal Reserve. So ultimately, there's going to be conflict one way or another. Ultimately, it comes down to what the data shows in terms of understanding just what momentum there is in the U.S. economy.
2 Fed hawks already digging in. And you can see that based on the recent Fed speak. Coming up this hour, we'll catch up with Kristen Bidley of Citi Wealth as equities inch higher. Monica Guerra of Morgan Stanley as President Trump's Canada tariffs hit a snag in the House. And Steve Ricchiuto of Mizuho as investors await fresh labour and inflation data. We begin this hour with stocks holding near all-time highs following a choppy 24 hours. Kristen Bidley of Citi Wealth writing bifurcation will continue within software and the broader market, highlighting the need for diversification. Kristen joins us now for more. Chris, good morning.
Good morning.
Let's talk about that bifurcation. At the start of the year was software versus hardware, and that's been going on for a number of months. Have things got a little bit more complicated?
I think in a good way, actually. I think things have gotten more complicated where it's no longer we're just going to take at face value the AI trade and everything's going to grind higher. I think this bifurcation of saying, OK, let's look at earnings, let's look at the CapEx spend, and we're going to delineate between those who are actually seeing an ROI on that expenditure and those who are just spending money. If you don't see the ROI, investors are getting less patient, and I think that's healthy.
As we see this disruption cascade from industry to industry, there are others who are just hiding elsewhere. Julian Emanuel of Evercore was on the programme in the previous hour. People are just hiding in staples.
I know,
which is amazing. They don't really know what to do.
Amazing.
So everyone's talking about this cyclical upswing, and you've got staples up double digits year to date. Does that make sense? And I think
it doesn't entirely make sense because you would normally think if people are putting money into staples, it's almost recessionary fears are front and center. But I would say, where can you hide in certain industries that cannot be penetrated by AI? I think it's as simple as that. You have the valuation play as well as something where it's like, is this industry going to be disrupted? Where people are starting to ask the question, what is going to be disrupted? And then also, when are they going to start to see the productivity gains? Which is also why we're seeing some of those sell-offs when it comes to even what came out about wealth management, real estate services. What does it mean for those models going forward?
I won't press you on wealth management for obvious reasons.
I would love to talk about it, actually.
The disruption divide seems to be the story. It doesn't feel like anymore it's a cyclical story. It just feels like it's based on the disruption divide.
But I think this is, again, you have the first part of this equation is infrastructure. And then looking at that significant amount of spending, is that a bubble? When are we going to see the ROI? It's not a bubble. It's really kind of the infancy stages of this. And that's going to then benefit a number of other industries. Then you have the application of that infrastructure spend, which will flow through to areas like financials, like insurance companies, like logistics and trucking. And so then it's who are the beneficiaries, and are they making the right investment decisions to then be true beneficiaries of this?
Let's talk about wealth management. We went there in terms of the disruption and how much you could actually be taken out of a job for AI, because we're all wondering the same thing about ourselves, and how much can this sort of iterate in order to make us completely obsolete and irrelevant. Was it interesting to you when it hit the industry that you're in to understand what people were not understanding, or did you get a sense of just abject fear and go into a bunker?
No, we've been preparing for this for quite some time. So when you think of how AI impacts wealth management, it makes us better at our jobs. So there's that common phrase where it's, the person, AI is not going to take your job, but the person using AI is going to take your job. So this makes all of us more productive. But what we also need to take a look at is, it's not just about the AI tools. Who has the data? So the underlying data becomes critical. So for example, within my business, we've been covering law firms for 56 years. We have extensive data on the state of the law industry, also on lawyers themselves in terms of their financial plans, their career progression. So if you're going to take something like a financial planning software, yes, it's great to have the underlying balance sheet kind of calculations, but if you can combine that with really powerful data and insights on industries that are unique to you, at Citi we have credit card data, we have data on the consumer, we have data on how people are investing, it then multiplies that.
So data is the edge. You work with law firms. That's another area that people are now talking about potentially being disrupted. Why get an associate that's never going to sleep and have a miserable life when you could just use ChatGPT that's never going to complain? I'm just wondering at what point...
Those are real structural changes,
So those are real. So then at what
think...
point does that really reduce headcount and reduce the need for the human in the equation?
So when we talked about the employment backdrop, one of the things that we've talked about on this program together before is I am concerned about the youth unemployment rate. That is an area, we talk about it within like the legal profession, that you used to have this pyramid structure and it's moving to more of a cylinder because you don't need as many first-year associates. And you're seeing that actually come to fruition, not in the future, but in today in terms of hiring plans. So there will be structural changes in terms of what your workforce and labor force looks like. And I think that's going to impact not true advisors, but it will impact some of the entry-level positions.
If you're wondering where the rant came from because it felt so personal, Lisa was almost a lawyer. And then
is this a true
out.
story? All right.
Bramo chose to be a journalist instead of a
Actually,
lawyer.
do you want to know the truth? A law professor who is my advisor said to me, you would love law school, you would hate being a lawyer, go be a journalist. And I said, okay, I'll do that.
Will AI change that for you?
Go back to being a lawyer? I can adjudicate things while on air.
Kristen, so much of this is happening, and that's true. So much of this is happening in the US. So much of it's driven out of the US. And yet we had a guest 30 minutes ago talking about the opportunities elsewhere in Europe. Is it the end of US tech dominance? Is it the end of supremacy in the equity market?
I don't think so. I think, look, the flows year to date absolutely are showing that people are diversifying away from the US, both in terms of the dollar as well as the equity market. So if we look at what's rallied, you can look at Japanese equities, you can look at Korean equities, you can look at emerging markets in terms of the price action that we've seen year to date. But we need these mega cap stocks to perform, and they are the ones that are really driving the expenditures, they're driving the innovation. And when you look at their earnings growth, it's still really impressive. So this is they are delivering from an earnings standpoint. So to be on the forefront of innovation and the investment and what's really going to drive long-term secular growth, the U.S. has to be there, and these mega cap companies need to as well.
What we hear repeatedly, and I'm sure you hear the same thing, is that the international investor base is nervous about taking additional dollar exposure. Now, I know additional dollar exposure because they've taken so much over the last decade. Do you hear the same thing?
I think the major thing that we're hearing, and I actually just came back from Europe, I was in London and Madrid last week, the major thing is when you look at last year was painful, right? In terms of yes, you had U.S. equities rally, but when you then translate that back into your home currency, if you're a euro-based investor, that totally changes the equation. But for your average U.S. investor who is very dollar-based and very dollar-centric, it's not really an issue.
I'm curious, given the fact that you do travel, given the fact that you talk to so many investors, how has sentiment shifted from the end of last year to now, which feels like about 15 years?
So we did a poll. We had a couple of events in Madrid and in London, and we did a poll, and it basically ended up exactly the same in both locations. So it was, instead of us talking about our outlook, which is constructive, and we do believe that there are tailwinds with volatility, It was about 60% of participants. It was consistent across both locations. 60% of our investors were constructive and bullish and saw some tailwinds in terms of the earnings backdrop, and particularly even within the U.S. market. 20% concerned, and a lot of it was around, are there structural changes that we need to be anticipating? And the remaining 20% just admitted they were entirely confused.
Count me in that bucket.
I think I'm in that group too. Chris, it's good to see you. Thanks for
Good
dropping
to see
by.
you
Thank
too.
you. Kristen Bidley there of Citi Wealth. Can you imagine if we lost Bramo to the legal professional? That would just be awful.
There is a huge cohort would probably be clapping. So, too bad. Sorry.
I'd hate it, Bramo. I'd hate it. Let's give you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. CarMax topping hotel industry veteran Keith Barr as its next CEO. Barr will take the helm in March and will be challenged with improving CarMax's online sales experience and lowering costs. He previously served as CEO for IHG for 6 years. Anthropic nearing the completion of a deal to raise more than $20 billion. Sources telling us here at Bloomberg the funding round is co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw and Dragoneer Investment Group. Anthropic is said to be valued at about $350 billion, and that announcement could come as soon as this week. WhatsApp says the Russian government has moved to block its messaging app. Russia removed technical internet records that help connect platforms like WhatsApp, making the services unreachable from inside the country. The Kremlin pressing citizens to adopt a state-run app called Max. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, trade policy pushback.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs.
6 Republicans crossing party lines, some pushback on Capitol Hill. That conversation up next with Monica Guerra of Morgan Stanley. Live from New York City this morning. Good morning. Pretty decent. Strong payrolls data just yesterday. Later this morning, about an hour from now, you'll get jobless claims. Another read on the labour market in America. The estimate in our survey, 223. The previous number, the wrong kind of upside surprise. We got 231. We're looking for that number to come back down and get further signs that this labour market is stabilising. In this equity market, equity futures look like this. On the S&P 500, firmer by 1/3%. On the Nasdaq, up by 0.26. On the Russell, up by 0.6%. Curious that the gains in the Russell and the small caps did not stick yesterday. Didn't hold even with that stronger than expected economic data. Something that did stick, this move here in the bond market. Repricing at the front end of the curve. Just pushing out, not totally pricing out, but pushing out the prospect of further interest rate cuts from the Federal Reserve.
The hawks got ammunition. Why would they cut rates if you see the labor market potentially stabilizing and not exactly falling off a cliff? Ultimately, tomorrow is going to be really important. The idea that we're going to get the inflation read, CPI, will give us a sense of just how much leeway they have to potentially cut rates on disinflationary trends, even if you aren't seeing any kind of deterioration in labor.
You mentioned Morgan Stanley a little bit earlier. Mike Gapin is the one looking for precisely that. Not weakness in the labor market, but softer inflation, leaving the door open for them to reduce interest rates. And they're the kind of cuts that Kevin Walsh would love to deliver, because they're not complicated. You come out and say inflation's lower, I'm cutting interest rates, as opposed to everything's fantastic, growth is absolutely flying, and you're cutting interest rates because why?
Yeah, exactly, which leads to the whole political question. There also is a really bad message that he could send if the labor market does crack. You don't want to say, I'm cutting interest rates, because guess what? We need them, and we need them badly. That is not the right message the market wants to hear either.
Some pressure on that man before he even gets confirmed at the top of the Federal Reserve. Out of surveillance this morning, trade policy pushback.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs. So we're doing numbers that nobody thought were possible. 78% reduction in our trade deficit, and next year we're going to be positive if we keep it all going.
Congress isn't celebrating. Here's the latest this morning. 6 House Republicans defying the president, voting to block some of his tariffs on Canada as unease over the administration's economic policies continues to grow. The president vowing consequences for any members of his party opposing the levies. Tyler Kendall has more for us. Hey, Tyler.
Yeah, hey, John, good morning. Well, this marks the strongest political pushback that we've seen against one of President Trump's signature economic policies as we head into the midterm elections. And House Speaker Mike Johnson tried to prevent his members from taking this politically fraught vote. He had tried to delay it until at least after the Supreme Court rules on President Trump's broad-based IEEPA tariffs, but at this point, they're now all on the record. And if you're a reporter here in Washington, you get inundated with campaign emails. And I have to say, after this vote took place, my inbox was flooded with Democrats targeting Republicans in farm states who voted in favor of the president's tariff policies. Now, Democrats want to make this a top focus as Republicans play defense, according to the polling, on the economy. But the White House is still defending its policies, and we should say that the vast majority of Republicans did vote with the president on this one. But still, if you were one of the 6 that didn't, President Trump really could make good on some threats to hurt them come the primary season, because he has amassed a record $483 million war chest. And people familiar with the matter told us last month that he plans to be personally involved in how that cash gets deployed. Plus, keep in mind, this is just the first in what's expected to be a series of votes targeting President Trump's tariff policies. This vote was about Canada, but we're expecting another one later this month looking at the tariffs levied against Mexico. John, with all of this said, and just to be sure, this measure now goes to the Senate, where it actually really likely could pass, but then it will come to President Trump's desk where he would veto it. It would take a 2/3 majority in both chambers to override that veto. So none of this legislation is probably going to turn into law, but at this point, it really is showing that perhaps more symbolic push on the behalf of lawmakers as we head into November.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Joining us here in New York is Monica Guerra of Morgan Stanley Wealth Management. Monica, good to see you.
Good to see you.
So the calendar, let's get to the calendar. So at some point, USMCA renegotiation, there's a meeting with Xi Jinping in the spring. There's already pushback on Capitol Hill. How is that going to shape outcomes for the year ahead?
So when we're thinking about USMCA, it's really critical to remember that this is a review. And typically, you don't get a renegotiation. But what we're seeing is that renegotiation's on the table. So you had China and Canada have a conversation while we have reason to believe that Canada did communicate that with the U.S. in advance. It still is setting the stage, right, for hardball when we're thinking about actual renegotiation this summer. So we're waiting to see what that looks like, and then we have this pressure from Congress adding to the table. So everyone wants a voice in this negotiation, not just the president.
This isn't NAFTA. That's gone. The president called it USMCA. Mm-hmm. It's his. What doesn't he like about his own deal?
One of the biggest areas where you get the pressure is with the UAW, right, the United Auto Workers. They're really looking at essentially lessening the pay differential between U.S. Mexico, U.S. Canada. You're also seeing a lot of fair trade and fair worker concerns. So you're getting this from the trade unions. They're looking to have a lot of pressure alleviated off the table. The president also wants Canada and Mexico to affirmatively pull away from China. You've seen some, more firm action on the Mexican side of the border, but not necessarily with Canada. Canada is now saying, hey, we're an open buyer. We don't necessarily have the same, geopolitical viewpoint. We aren't the founders of the Monroe Doctrine, so we're okay with, starting negotiations elsewhere.
How much does this latest House vote constrain the president? And I say this because he's going to renegotiate this without necessarily a vote of faith and confidence from particularly a number of Republican Congress members that are on the border, that actually have business with Canada and are realizing this isn't going to be good for their constituents.
What this really shows is cracks, right, in the party. We've seen really lockstep support of the president. Where does it actually move the needle? Potentially, I would say right now from a legislative standpoint, no, you're not going to be able to get this through the Senate. What's interesting about this, though, is that if you have GOP members defecting, they are pretty positive, I guarantee it, pretty positive that they could withstand a primary. So this is essentially not necessarily a game changer for them with their electorate because their base is concerned about this issue, right? So any sort of challenger that would come in, I think that would be a very difficult fight.
They're concerned about affordability, and that has been something that keeps coming up. It seems to be the word of the year, at least on the political front. I just wonder what more Congress can do. Can they provide additional stimulus with the support that they have, with the concerns about the deficit, and frankly, with the jobs number that we just got that beat expectations?
So one of the things that we're really looking at from a stimulus standpoint is, pre-midterms. So Again, once we get through that USMCA renegotiation, you get through August, then it's going to be full-blown campaigning. And that's when you're likely to see more of the affordability measures come in. Maybe you get more on housing. You're likely to get some movement in healthcare, whether that's pharma caps or a Trump healthcare plan. We don't know yet. But they're going to essentially look around the edges and see where they can make good on that affordability promise. The other thing that's really critical that people aren't paying really close attention to is the OBBA tax cuts and how those tax refunds this year are going to be at record highs, about 40% higher than we had in the last year. This is notable because what it does is that it alleviates the debt side of the equation and the consumer staples side of the equation. People think, oh, you get more cash on hand with a tax refund, that would go to consumer discretionary. That's not historically what the behavior is when we're thinking about behavioral finance. People take that money, they pay down their credit card debt, they pay off the debt that they incurred over the holidays, and then they essentially get their house in order. So we think this is a real boon for consumer staples throughout the year and not necessarily discretionary.
So let's stay on this. For people who don't follow your research, you do have the winners and losers of the legislation coming out of Washington. Winners staples, losers discretionary. That doesn't sound like stimulus. And when I was reading through your note, I was sitting there thinking that because so many people are coming on this program talking about these refunds and talking about the stimulus that it will provide for the US economy. You don't share that view, do you?
Well, I wouldn't say I don't share it. It's going to essentially benefit, right, the lower end retailers. So you have to think about it really not just sectorally, but where within those industries. The thing that where you're going to get stimulus is going to be on defense spending. It's going to be on these major bills that they're likely to get through in that second half of the year. Affordability measures are helpful. They're a nice talking point, but they don't really come home to roost until 2027, 2028. So when we're thinking about stimulus, you got to look at where's the money actually being allocated, and that's likely to be with defense and other areas.
Speaks to where the outperformance has come from, Bramo, so far year to date. For lots of different reasons, not just the AI story and hiding in a bunker, but the staple stories really perform well.
When you think of stimulus, you think of discretionary spending.
Things that help the cyclical trade.
You think of things like traveling more. You don't think of people buying more food to stock up their pantries. You don't think of people reloading on shampoo and conditioner. So this really speaks to how different the financial backdrops are for some people than others, and that the people who are most likely to spend this extra income are the people who are going to be spending it on Campbell's soup and maybe some shampoo.
This really speaks to that K-shaped economy. So on the upper end, the reason why they're not stimulating up at the upper end is because that spending's already happening. That travel is happening. The discretionary spending's happening in that space. So what they're looking to do is speak to that lower leg, right? Those that really need that, feel that affordability pinch. And that's why it's important when we're thinking about staples. It is going to stimulate on that end in a way that we haven't seen.
Monica, this was great. It's good to see you. Thank you. Monica Guerra there of Morgan Stanley. Staples year to date, not just an AI trade, what you just heard there from Morgan Stanley, also a tax refund trade. Year to date, up by double digits. In just a moment, we'll catch up with David Tinsley of the Bank of America Institute as the K-shaped economy opens up. And they note in their data a widening divide, not just between low income and high income, but middle income and high income. The problems are migrating up from low income to middle income.
Housing costs and healthcare costs are eating into the average family's income in a way that isn't being priced into how we categorize some of these levels.
We'll speak to David in about 5 minutes' time. Plus, Yahira has your morning movers. Strong demand for memory storage, lifting shares of SanDisk and Micron. Big moves in the pre-market on those names once again. Big moves so far year to date. Wild rallies worldwide. Equity futures on the S&P up by 1/3% on the S&P 500. 1 hour from now, jobless claims the next stop for your economic data following a stronger than expected payrolls report in America. Two days, no gains. Let's see if we can turn it around. We're positive by 1/3% on the S&P, and the Nasdaq up a similar amount. And your outperformance from the Russell higher by 0.6%. In the bond market, talked lots about a 2-year back above 350. Just a break of that, we're down a basis point. On 10s, we're down another basis point too, and down 2 at the long end of the curve. 30s to 478. Just how quickly we faded that post-payrolls bump in equities and in foreign exchange, and now to some extent in the bond market.
How many notes did you read? Take it with a grain of salt. You know, I'm not necessarily confident that this indicates some sort of shift How about that birth-death model? How about the downward revisions? I mean, how many holes were poked in it in some of the notes that we got overnight? You can argue, okay, nonetheless, this is a pretty good number. This doesn't necessarily, though, scream of growth that really would supersede any kind of disinflation that potentially could cause rate cuts.
Look, there's an obvious bias, I think, for a lot of people, conditioned by experience of the last 12, 18, 24 months, just to mentally revise the jobs figure down, because ultimately in 12 months' time it will be done anyway by officials. So why wouldn't you? Can you really put much weight on this? I hope we see it continue. I would say that the only supporting factor right now in the data that I've seen over the last week or so is the ISM. Outside of that, a lot of it is going against the grain. Jobless claims being one. I hope it turns around in an hour from now. Challenger job cuts were problematic. Jolts were problematic. The sentiment surveys haven't been great either.
And in the payrolls, you did see construction workers actually pick up in terms of employment in some of the other areas in the industrial sectors. To your point, how much does this really up the volume, increase what we do when we pay attention to jobless claims in order to really correlate what we saw yesterday?
Claims 60 minutes away. We'll look out for that as we count you down to the opening bell, 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Cisco is the latest company to warn us that rising memory chip prices will eat into profits this quarter. So shares are falling 7% in the pre-market. That overshadowing what was otherwise a solid report by Cisco, with its sales outlook coming in better than expected due to its role in the AI infrastructure build-out. And that pricing warning is lighting a fire under the memory chip stocks looking to cash in. You're seeing SanDisk up 6.6%, Micron up 3.5% as more companies talk about memory shortages and higher prices during this earnings season. Analysts at Goldman calling it the great memory crunch as AI data centers can't get enough and supply just isn't keeping up. And speaking of data centers, we end on Equinix. This is the world's largest the largest operator of data centers. Shares are up nearly 10% in the pre-market after the company reported record fourth quarter sales and a better than expected 2026 outlook, all due to AI-related bookings. John?
Yeah, I'm not shocked at all. Yahara, thank you. If you operate data centers right now, we can imagine who your customers are, can't we?
There are a couple of names, and they are big, and they are competing with one another to try to get capacity to make sure that their competitor isn't going to get it. So a definite race going on in that space.
Spending serious money. On our radar this morning, the Congressional Budget Office issuing a fresh warning for the U.S. fiscal outlook. The CBO raising its estimate of deficits for the coming decade by $1.4 trillion. President Trump's tax law and immigration policies outweighing tariff revenue. Elsewhere, Apple's latest Siri upgrade facing the possibility of further delays. Sources telling us here at Bloomberg the testing of a new update revealed sluggish response times and accuracy issues. Features meant to be released in March may not be available until May. And finally, McDonald's fourth quarter U.S. sales growing at the fastest pace in more than 2 years. The company's offering of more affordable menu items and value meals is paying off.
It increased traffic, right? It increased customers coming in the doors and buying extra value meals that had been cut in terms of price by 15% or more late last year. This is similar to what we heard from Pepsi. This is similar to what we've heard from other fast food retailers. And I just want to read you this quote from the CEO, Chris Kempczynski. As I've said before, and I will say again, McDonald's is not going to be beat on value and affordability. This raises the question about how much you end up with some sort of war in terms of lowering prices. And it speaks to the fact that going forward, this is not changing. This is the bottom of the K that is not improving, is not seeing their circumstance really materially get better, which is a reason why it really has to come down to adding value, i.e. cutting prices and giving customers something that they feel is worth it.
They've had to lead on basically franchises to get them to cut prices. I think we all saw that value meal for $18 in Connecticut. Did you see those pictures?
Yes.
In the last year? Warren Buffett would say price is what you pay and value is what you get. If I'm paying $18 for a meal at McDonald's, I'm not getting value. And by definition, that is not a value meal. And that's where the big effort has been in the past 12 months, just to push those prices lower and to give them the support they need to make it happen.
There are two ways to view that. On one hand, you could view this as they went too far with some of the price increases over the past couple of years. The second thing is that people are becoming that much more sensitive to what those prices are and are pushing back in a more serious way than they have in the past. And that latter point is the concern, given what we are seeing in terms of both the labor growth dynamic as well as what we're seeing with debt and so the ability to pay, certainly in delinquencies.
Consumer price tolerance was right up here coming out of the pandemic. Charge what you want, people to pay it. That's what people thought. Consumer price tolerance has absolutely sank over the last year or so. Let's stay on that story. Credit card spending rising to its highest level in nearly 2 years last month. The Bank of America Institute writing, "We are concerned, though, that a K-shape is opening up between higher income and middle income households alongside the existing gap with lower income households." David Tinsley of the Bank of America Institute joins us now for more. David, welcome to the programme. Let's talk about the headline number and the strength we're seeing, and then we can get to the disparity and the bifurcation beneath. David, the momentum at the top line, are you encouraged by that?
Yes. I mean, like you were saying in the graphic there, 2.6 year over year. That's a pretty strong number, strongest in nearly 2 years. Bear in mind, it was a pretty bad month weather-wise. You know, bits of the east, bits of the south were sort of shut down at the end of the month. So I think, in aggregate, the story is a solid one.
In aggregate. And that's really the headline, David, because beneath the surface, it really isn't. I was going through the stats that you and the team put out in the last 24 hours. This gap opening up between middle and high-income Americas, just how wide and how quickly is that widening happening?
Well, yeah, that's exactly the point. The aggregate is fine, but then when you look beneath that, there's like the jaws of a crocodile, in which the top of the K, higher income households, spending growth 2.5–3% over the last few months. Lower income households, 0.3 in January, sort of quite close to zero, really, over the last few months. What we're really concerned about in the data right now is that the middle income group, which for a good period of time last year was in the middle between that lower and higher story, is sort of drifting down closer towards the lower income consumer end. And of course, you know, put simply in a macro sense, the lower income consumer doesn't drive the economy. But the middle income consumer is a very important part of the overall consumer story. So you can't really afford to lose those guys.
Why do you think this is? Why has the picture gotten worse for middle-income individuals, considering the fact that the stock market is up? Is it a lack of an exposure to the stock market? Is it their jobs that they're in are not seeing wages increase as fast as elsewhere?
Well, you know, when we look at our spending data and then we look at across the wages data we see coming into our customers' accounts, we get a very consistent story. So these middle-income households have seen a softer wage growth picture over the last few months. It's running about 0.4 percentage points, 0.5 softer than the last 6 months of last year. So, you know, to answer your point, I think mainly it's a labour story. And really, most of these households don't have a lot of equity. They're not really exposed to the wealth effects. That's very much a kind of top income tier story there. And there, you're seeing a much more consistent story in terms of spending.
Based on that backdrop, do you think that we're underestimating or overestimating the influence of some of the tax cuts that are expected to trickle through in the first couple months of 2026 in the United States?
What we see in our data when we look back over the last few years is that people tend to spend their people who are going to get larger tax refunds tend to file early. And when you look at lower income, younger households, they spend more of that tax refund than the other groups. You know, in a sense, it's very intuitive. So I think we will see a jump in spending and some easing in the affordability issues from those lower income households, those younger households. My concern isn't really so much as the sugar rush of tax refunds, it's when they wear off. So in our data, we see deposits staying high for about 6 months after these tax refunds come in. People kind of whittle them down slowly. But, you know, look at the end of this year, say, if that labour market position remains soft, then that makes me more concerned about how, essentially, what is going to be the driver of consumption at the back end of this year.
David, just on the spend, typically, when you track that money, where does it go? We had a guest from Morgan Stanley on a moment ago who said a lot of that cash is just going to go to staples and not discretionary. What's your read on things? What do you see in the actual data?
Yeah, well, it's a sort of mixed bag, really, and I think that is right. Basically, you know, affordability issues are at the forefront right now, and when we look at things like trade down, we're seeing lower income consumers spending at grocery stores running much stronger than they're spending at premium stores. And we're also seeing rental costs, to give you an idea, around a quarter of lower-income households, their monthly rent is worth more than 50% of their household income. So these are quite restrictive affordability issues. So I think, yes, I think the tax refunds will ease affordability issues. We'll see some leakage into discretionary, I'm sure, but to the extent that it's a lower income and middle income story, it will be more on groceries. Maybe there'll be some easing in terms of quick serve restaurants, you know, referring to your piece earlier, you know, the value meals, etc., might come back into vogue a bit more.
David, it's good to see you. Thanks for breaking down the latest data.
Thanks a lot.
Thank you, sir. David Tinsley there of the Bank of America Institute following their Consumer Checkpoint report. If you missed that yesterday, consumer spending showed solid resilience in January. Total card spending from internal data rising 2.6% year over year, strongest pace in nearly 2 years. That's kind of where the good news ends. Beneath the surface, the wage growth gap between higher and middle income, the largest in nearly 5 years. And it's that middle income squeeze that team is concerned about.
You know, if you think about some of these jobs that typically are thought of as middle income types of work, office managers, sales managers, executive assistants, some of the roles that might get disrupted by artificial intelligence. There are others that won't, right? Registered nurses, I'm thinking of, in other areas. But you start looking at this, you start wondering, okay, how much of this is also because there isn't the same kind of price pressure for labor that there has been in the past. This is a reason why people really want to understand that dynamic, because it is affecting that K-shape and how it is becoming pernicious.
That's the latest on the US consumer. If you want to check the markets, equities session highs up by 0.4% on the S&P, with an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. U.S. Energy Secretary Chris Wright says Washington can help Venezuela raise its oil, gas and electricity output this year. Speaking in Caracas, Wright saying the administration will issue new licenses for businesses to buy Venezuelan products. Wright is the most senior U.S. official to make a public visit to Venezuela since the capture of Nicolas Maduro. Federal agents are looking along roadways in the Catalina foothills near Tucson as part of the investigation into the disappearance of Nancy Guthrie. The Pima County Sheriff's Department and the FBI are saying they're following up on 18,000 tips. The mother of Today's Show co-host Savannah Guthrie has been missing since February 1st. The Fed is signaling plans to abandon some of the confidential warnings it previously sent to banks to improve operations. Sources are telling us here at Bloomberg the remaining flags will focus more on immediate risks to a bank's financial health, less on processes and procedures. Banks have argued that Fed supervision has become too complex and expensive. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes. Up next on the programme, the Fed faces the data.
What today's jobs data showed you is that underlying economic growth is fine, but when I look forward, I see inflation coming down quite dramatically this year. So I view there's being a variety of reasons still why I would want to see lower interest rates.
Up next, we'll get the view of Steve Ricchiuto of Mizuho from New York City. You're watching Bloomberg Surveillance. So this is the bull case. We heard from Eric Johnson of Cantor a little bit earlier this week. This is what it sounds like. Market's going to break out soon. Upcoming corporate buyback season, tax refund checks over the next 6 weeks. ISM turning higher, massive AI capex numbers we've all seen just announced. Throw in the payrolls report and it's going to happen, except this keeps happening. Keep bumping up against 7K. And the market cap weighted index, the S&P 500, just is struggling to break out. Even with the decent data we saw in the ISM last week, even with the payrolls we saw in the last 24 hours.
There's some structural anxieties underneath this. There's, on one hand, the real economy, which we don't have a real handle on. And then there's, of course, how much AI is going to be adopted and just be disruptive to a whole host of different industries. And all of these anxieties are leading to a mush that is leaving everyone just kind of churning.
Feels constrained, doesn't it?
It does.
The fear. And I will say the fear and the anxiety that this just cascades through the financial system and then ultimately ends up in the sector you're in, so you hide where staples, which was ultimately what Julian Emanuel of Evercore communicated to us about an hour ago. He's basically making the point that a lot of people are just worried and looking for somewhere to hide. They don't want to be the next software, the next real estate, the next, where were we in the last 24 hours? Wealth managers. Yeah. Who's next? Which sector?
I keep going back to Kristen Bitterly's poll. 60% relatively bullish, 20% very concerned about some of these disruptions, and 20% utterly confused. Pretty much sums it up.
It was easy when the Fed was just cutting interest rates and you piled into small caps and it all made sense.
This is so much more fun, though. I actually really enjoy the single name stories and how much things are changing.
Repricing the Federal Reserve in the last 24 hours. Under surveillance this morning, the Fed faces the data.
What today's jobs data showed you is that underlying economic growth is fine, but when I look forward, I see inflation coming down quite dramatically this year. So I view there's being a variety of reasons still why I would want to see lower interest rates. And while today's jobs data made me feel really good about the economy, I think the truth is that pushing out the supply side of the economy still allows for monetary policies to accommodate that.
So here's the latest this morning. The Federal Reserve facing a busy week of data on both sides of the central bank's mandate. The US economy delivering a blowout payrolls report ahead of a fresh read on inflation with CPI due tomorrow. Stephen Ricchiuto of Mizuho writing the first half of the year is seen benefiting from strong individual tax refunds, and the second half from last year's 75 basis point reduction in the funds rate. Steve joins us now for more. Stephen, welcome to the show. It's always good to catch up with you, sir. How much weight should we put on that payrolls report? Is it the real deal?
Well, I think when you back it up against the claims data that we've been seeing on a regular basis, I mean, ignore last week's numbers. When you look at where claims are, you look at where continuing claims are, and you look at the decline in the exhaustion rate, i.e. people falling off the continuing claims roll, you're seeing a healthier labor market environment, and you're seeing it actually picking up speed. You see a healthy labor market environment in the NFIB numbers. You saw some healthy data in the ISM numbers. I think, you have to look at all this data and say, well, why is it taking place the way it is? And I think the answer is because the economy is fundamentally healthy. And I think it is going to accelerate as we go forward into 2026. And I don't worry about the second half of the year, as I wrote in that little piece, because primarily we think the interest rate story comes up to really replace the tax cuts as the driver of the economy as we go into the second half of the year. Remember, in 2025, we had a real acceleration in growth in the second half of the year after a disappointing first half of the year, and the Fed was all worried about the first half growth decline, and that what they used to justify the rate cuts. But at the end of the day, the economy accelerated in the second half as a result of the rate cuts in 2024, and I think that continues to dominate again this year.
Well, Steve, I want to pick up on that point, the 12-month lag. What is the 12-month lag about? Because for someone just following financial markets, they might sit here and say, I might sit here and say, highly financialized economy, it goes through financial markets almost immediately, and you can feel the effect straight away. What takes 12 months?
It takes 12 months for people to reassess their situation, and we're really talking about a 6-month lag, which I think is the important piece of the equation, because there's usually this belief that monetary policy takes anywhere from 6 months to 18 months to be reflected in the economy, the long and variable lags that all Fed chairmen like to talk about. But the reality of the situation is those long and variable lags really depend on the underlying health of balance sheets. And I know you were talking before about the K-shaped economy and the adjustments taking place in the economy. But when you look at where the economy is and you go back, you're looking at 5 years ago, which was the COVID environment. And we're renormalizing to a pre-COVID environment. And that's what you're seeing in a lot of the data. When you look at things like delinquency rates relative to balances are very low, so delinquency rates look high. But when you scale them by income or you scale them by GDP, suddenly delinquency rates don't look to be a problem. This is all the type of normalizing analysis that I think we've been doing relative to other people that I think is really, really driving the point that this economy is on a solid fundamental trajectory. And I disagree completely about the argument that we're going to get inflation coming down. We've been talking about inflation coming down from 3% for several years now, and it isn't happening. How long are we going to continue to wait for Godot? That's the real problem, because the Federal Reserve has to wake up and smell the roses that inflation is stuck at these levels.
We'll get to inflation in just a second. I'm just curious. I'm dealing with whiplash right now after David Tinsley was just telling us that the middle class is falling into the same type of affordability crisis as the lower income individuals in this country. How do you square that story with this idea that there is stimulus that is working its way through the system?
Well, I think you come around with the fact that the corporate stimulus came last year. The consumer kit stimulus comes this year. A lot of people are just now filing their tax returns. They're just now getting their refund distributions. We're on the real exponential rise in refund check distribution. So we expect to start seeing it showing up in the data in the next couple of weeks. With regard to the concept of the middle income households, you remember you just went through the longest government shutdown in history. You went through a very, very cold winter, early winter environment. You went through the reciprocal tariff adjustments of last year. So seeing some disruptions get developed as a result of that is not surprising. It's where do we go forward that becomes the critical issue. The indicators that he's been looking at are basically indicators that tells you where we were and not looking at, well, if the economy does get the cyclical boost we're expecting, if labor markets do get the cyclical improvement we're expecting, then guess what? You wind up reversing all those trends after being worried about them for so long.
Stephen, going back
and
to the
data is beginning to show that's happening.
Going back to the inflation point that you're making, the pushback that you're hearing across Wall Street, and Tiffany Wilding of PIMCO put this out there, that after a period of stubbornly high rental housing inflation, you're actually seeing the opposite, surprisingly low housing-related inflation. And this is being borne out in a whole host of different data. I'm just wondering, where is the inflation going to come from?
Well, you're going to see it in the good side. I mean, we honestly believe that the acceleration in growth in the economy is going to lead to a greater demand pull equation. We think we're going to see it in a lot of those factors that really lead to higher prices. A tighter labor market environment will lead to higher wages. Higher wages will help contribute to stronger demand. Stronger demand will contribute to higher prices in some of the areas where good prices have been declining. This is why CPI is an index. It's not one component. And this is the thing everyone keeps on forgetting about CPI. Remember, 2 years ago, it was all about, oh, my God, you got to ignore the rising insurance rates that were driving CPI higher. The reality is you can't ignore rising insurance rates. You can't ignore all the other components. You have to look at the aggregate of the index. That's what really matters, is the aggregate, not all these individual components. You look at the number of components. I can always find something to hang my hat on to be bullish. Like people looked at the payroll employment number and they started doing some really apples to oranges comparisons in the birth death model. The reality is it's the best data we have. Stop arguing with the data. The data is the data. Accept the data for what it is. Make your analysis off the data. Stop looking for arguments within the data to discredit the data.
Steve, don't stop. This was great. Steve, it's good to see you. I've got 20 seconds. Quick question. Next move, hike or a cut at the Federal Reserve?
Nothing. They do nothing for at least 12 months.
Steve Ricchiuto of Mizuho. Steve, thank you, sir. 12 months on hold over at the Federal Reserve.
Love the data, hold the data, embrace the data, own the data.
The data is what it is.
The data just is the best thing that we've got, so stop arguing with it. It sounds very parental.
Preach.
Well,
seriously.
Come on, but preaching to deaf ears in terms of Wall Street right now.
Unchanged for 12 months at the Federal Reserve. It's another call, seen a few of them. It's not alone.
Yeah, a lot of people think that this doesn't give a justification to cut rates.
Coming up on the programme, Joe Amato of Neuberger Berman, Devin Ryan of Citizens, Matt Luzzetti of Deutsche Bank, George Bory of Allspring. The third hour of Bloomberg Surveillance. Up next.
All of these trades right now are so sort of knife edge.
Tech is a much more nuanced sector now.
If you look at places where we've outperformed, it's been the physical over the digital.
The tactical case for a continued bounce from here is pretty strong, I would say.
We think we're going to go back to a high-quality, large-cap trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P positive by a third of 1%. Call it a quarter on the Nasdaq. On the Russell, up by 0.6 in the bond market. Yields at the front end of the curve around 350 as we start to reprice this Federal Reserve. Going into more economic data later this morning. That data is 30 minutes away. jobless claims follows a blowout jobs report.
Jobless claims take on more import right now because there were so many questions around the non-farm payrolls report. Yes, it was a very big number. It was a beat, 130,000 jobs created. Nonetheless, people looking at all of the things that Steve Ricchiuto just told us to ignore and saying, hold on a second, can we really get confidence that there is a reacceleration in the U.S. labor market? The peripheral data will matter to confirm the story that people are telling.
Well, Steve's point is that the rate cuts we saw at the back end of last year are going to hit in the second half of this year. And that's where you'll see the growth. So for those of you that just think you get a one-off bump from the tax refunds, they're wrong in Steve's mind, because you'll get that bump also in the second half. That's why he's bullish the next 12 months.
The hard thing for me is that to speak in averages right now is so difficult, given that the circumstances for different cohorts of the economy, both on a company side and on a family side, is just so disparate that it's very difficult to understand which way overall averages are going to break.
Lots of disparity beneath those averages, and we can talk about the bifurcation elsewhere in just a moment. Futures positive by a third of 1% on the S&P 500. Coming up this hour, Joe Amato of Neuberger Berman as markets search for direction. Devin Ryan of Citizens challenging the AI disruption narrative. And Matt Luzzetti of Deutsche Bank as Wall Street watches for the latest read on the labour market. We begin this hour with stocks steady near record levels. Neuberger Berman President Joe Amato writing a mix of past and future stimulus, rising business confidence and improving loan growth set the stage for further equity gains. Joe joins us now from what? Joe, good morning.
Good morning. Good to be
Where
here.
are those equity gains coming from?
Well, you've seen this rotation. So the things that have been driving the market over the last couple of years have now switched over. So the broadening out theme that we've talked a lot about, we were probably early in that theme. It didn't play out necessarily fully last year, but you're seeing it this year. So while the market, as most people would describe it, the S&P, is up just a little bit this year, you know, value's up 8%. Small cap stocks up 10, 12. You've got European stocks up. You've got Japan, the best performing market, major market in the country. So this rotation into things outside of what's worked over the last 2 years, I think is an important trend. And I think it's driven by accelerating growth in overall economic activity.
Equal weight, all-time highs on the S&P 500 speaks to the same thing. Is it just a cyclical upswing, or is there an AI disruption theme to all of this as well? Are these just better places to hide from getting smacked around the head one day by some update somewhere?
I think it's both. I think, yeah, we coming into this year, we did think that the nominal growth was going to increase, cumulative rate cuts, fiscal stimulus. So a number of those things have in fact played out. So you're seeing GDP growth, whether it was the second half of last year and going in the momentum continuing in the first quarter of this year. But at the same time, you have disruption. So, you know, AI has been sort of like a heat-seeking missile looking at different sectors in the equity markets. You know, first it was software, then it was private credit, then it's data service providers, this morning real estate companies. So, you know, that disruption, and I think we may have even talked about it last time I was on the show, which is this AI is going to be the most massive creative destruction process we've ever seen, and it's going to be happening faster than we've ever seen it. And the last number of weeks we've seen it manifested in the markets, but it's hard to prove the negative about, you know, if you're a company that's still seeing good financial results, yet you have some vulnerability to AI disruption, you know, the market's just selling first and, you know, and then moving on.
You should trademark that analogy, a heat-seeking missile in terms of the AI trade, because it really just describes what's been going on in markets over the past couple of days. I'm curious, and we'll get to that heat-seeking missile in a second. I am curious, though, does that mean you see the cyclical part of the market as being maybe less sensitive to the economic data than other people do, because it is this dual type of trade?
It's a little bit of the revenge of the old economy. So you're seeing manufacturing pick up, some of the pressure, the areas that suffered from very modest growth over the course of the last couple of years are now seeing better growth, and they are vulnerable. You know, the automation trend going back 10 or 20 years ago put pressure on blue-collar jobs and a lot of pressure on those businesses, and professional services are now seeing the impact of that disruption.
So from your perspective, do you avoid that heat-seeking missile, or do you follow it? Are you the ambulance chaser that goes in and tries to pick up the pieces after it's already done its thing?
I think we're more looking to sort through when everyone's throwing the baby out with the proverbial bathwater, you know, who may be more, you know, competitive in the context of whether it's a software company, whether it's a private credit entity or what have you. So I think the market overreacts to these things. Naturally, the pendulum always swings too far in both directions. And I think it presents some opportunities for intermediate to longer term investors.
Things are moving so quickly, so fast, and that's something you just alluded to, and I think that's a major feature that we need to discuss. Typically, we embrace creative destruction in this country. It's a feature of American dynamism, or at least it used to be. Now it's moving so quickly, I just wonder how much constraint there will be down in a place like Washington, D.C., how much pushback we'll actually find.
Well, I think the manifestation of that's going to be in the labor market, and you've got these trends of stronger economic growth. A big chunk of the economic growth was AI infrastructure investment, right? So you saw good economic growth the second half of last year with virtually, not zero job growth or very little job growth in the second half of last year. So, I think there are going to be important public policy and political decisions to be made when some of this disruption starts to manifest itself in a tough labor market.
Does that influence how you think about investing over the long term through this cycle?
It does. I mean, you've got more volatility. I wrote about in a recent piece I did around, just wider ranges of outcomes of policy you're seeing over the recent election periods, and I think that becomes more challenging for businesses to plan longer term. So we're seeing businesses themselves be shorter term in their thinking, because policy and regulatory issues may change. Think about, regulatory policies during the Biden administration, now in the Trump administration, was almost a 180. So that makes it harder, and that's, I think, contributed to the short-termism in markets, which is frustrating for us, because, again, we like to think longer term, maybe 1-3 year, 3 to 5 year type horizons. It's tough given the volatility in policy.
Does that potential overhang of regulation, of a policy prescription that could potentially constrain some of this tech development, also constrain the potential for big tech to really be the leadership in the equity space?
Well, I think regulation is coming to AI and tech in general. The more power that tech has in the economy, I think the more attraction they're going to get from politicians and consumers concerned about some of the excesses that could occur. So, the balance between federal regulation versus state regulation, for instance, in AI, is going to be an important determinant of how the U.S. remains a leader in AI or whether it gets dragged down by a patchquilt of state regulation.
How much is this part of why Chinese technology, South Korean technology, Asian technology in general is getting bid up to a much more significant degree than U.S. technology right now?
I think those dynamics are going to come to every economy that you see disruption. So obviously the regulatory framework in China is going to be different than the U.S. But you are seeing the sort of China-dominated tech ecosystem and a Western and really U.S.-dominated tech ecosystem, and they're probably not going to interact much. But I think the dynamics affecting the labor market are going to be similar over the long term, and whether you're a Chinese regulator or whether you're a U.S. regulator, you're going to have to deal with it.
Joe, where are you finding diversification at the moment?
Well, value, small cap, non-U.S. So that's really where we've been overweight, and that rotation has.
Can I just pick up on the non-U.S. piece
Yeah.
of that? Lisa just talked about the gains we've seen in places like South Korea. Is it still just the same trade as U.S. tech, or is it different?
South Korea, Taiwan, these are very narrow markets, only a couple stocks driving the indices. So I would think a more broad-based market like Japan is more broadly investable to diversify from what, again, has been working over the last couple of years. We're not negative on the U.S., but it's just we think this rotation and the growth and the broadening out is going to be an important thing.
Is Japan working despite higher yields or because of higher yields?
I think Japan has shifted from a deflationary regime to an inflationary regime, which is a hugely important issue for equity markets. You combine that with constructive fiscal policy. We are certainly looking at the JGB market, because if that gets unhinged, that could derail this
Is it
growth.
unhinged?
But not yet. But probably most importantly in Japan is the emphasis on driving better shareholder returns and a focus on improving returns on equity for their companies, which has really been a secular trend that we've played for the last few years.
A big push since the Governor Kuroda days and Abe.
Yeah.
10 years
it's
or so
really
ago.
a continuation of Abenomics.
Without a doubt. Joe, it's good to see you.
Yeah.
Thank you very much. Joe Amato there of Neuberger Berman, the president. Japanese equities up by 15%. It's close to that level year to date.
And guess what? Japanese bond yields have actually been falling. They fell some 10 basis points in the long end overnight. Why? Because people have more confidence in the idea of who is going to govern and how they're going to govern. And frankly, the Prime Minister has come out pushing back against some of the profligacy of fiscal spending plans in the past. So right now, actually, it is exactly the opposite of what people thought if she consolidated her majority.
Some better news out of Japan, let's put it that way. Elsewhere, stateside, equities up by 0.25% on the S&P 500. With an update on news worldwide with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. AI company Anthropic nearing completion of a deal to raise more than $20 billion. Sources are telling us here at Bloomberg the funding round is co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw and Dragoneer Investment Group. Anthropic is said to be valued at about $350 billion, and the announcement could come as early as this week. President Donald Trump says he told Israeli Prime Minister Benjamin Netanyahu that he intends to press ahead on talks with Iran. In a Truth Social post, Trump said nothing definitive was reached during their meeting in Washington, but he insists his preference is to reach a deal with Tehran. Netanyahu's office says the two leaders agreed to continue coordinating closely. New York's Waldorf Astoria is getting put up for sale. Sources tell us here at Bloomberg the Chinese owners are selling it only months after reopening following renovations. Real estate investment bank East Still Secured is expected to bring the hotel to market on behalf of the owners. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour in about 30 minutes' time. Up next, the morning calls, plus Devin Ryan of Citizens pushing back on the AI disruption narrative. That conversation up next. Live from New York City this morning. Good morning.
If you look at the start of this bull market, the only two sectors that have outperformed the S&P 500 have been communication services and information technology, the place where the hyperscalers reside. We don't think the next really intense episode of rebalancing happens until the AI trade reaches a crescendo, which we think is still well off into the future.
Julian, Emanuel of Evercore weighing in on this equity market. I think Julian over at Evercore has a price target on the S&P of 77.50. And his argument is basically that if you want the index level to have another 10% of upside into year end, you need those names, those big tech players to participate, which is why he thinks the leadership will return at some point later this year, even if he does like other parts of the equity market as well. Speaking of the equity market, equity futures right now in the S&P 500 heading into data later, about 15 minutes away. Futures positive by 0.2% on the S&P, higher by 0.16% on the Nasdaq. There's that move in the Russell, the 2,000 up by 0.55%. In the bond market, yields just a little bit lower. We're down a basis point at the front end of the curve, 350 after repricing high yesterday, following much stronger than anticipated jobs data. That's the market setup. Let's get you some single names, some morning calls. First up, Citi raising its price target on Cisco to 90, citing multiple expansion for AI stocks. That name's getting hammered. We're down 7%. Your second call from JP Morgan downgrading Kraft Heinz to underweight, saying ongoing challenges could weigh on volumes through the year. That name is softer, lighter lower by 1.5%. And finally, Piper Sandler reiterating its call on Newmark as overweight, saying even with AI fears driving a sell-off, its bull case is unchanged. Let's stick with AI. Wealth management firms struggling to recover from this week's sell-off. The Charles Schwab CEO, Rick Wurster, pushing back on the narrative that AI is bad for business.
For us, AI is a real accelerant. We're best positioned in the financial services industry to help clients with AI because of our size, our scale, the depth of our relationships, and all the data we have, which is a key ingredient to winning in AI. AI is a beneficial to our business, not a hindrance, and it's going to help us flourish and grow and serve clients in new ways and ultimately lead to the growth of the company.
Devin Ryan, the director of fintech research at Citizens, believes the AI vigilantes are overreacting, writing, "This feels far more like evolution than mass disruption. What these headlines ultimately point to is a familiar pressure point, pricing." Devin joins us now for more. Devin, good morning.
Morning.
I could sense that Rick Wurster was slightly annoyed by the price action. I've noticed from other research notes that other analysts are too. I shared this quote a little bit earlier from another bank. The generalist money flows are responding to the rapid AI product rate of change dynamic, overwhelming the deeper thinking fundamental software sector specialists. That was about software in the last week. You're the deep thinker, the analyst that covers these single names. Do you feel like the tourists have arrived and taken over your sector?
That's what it seemed like earlier this week. AI is not a new theme, and it's something that I think is going to be a really big deal. So I think they got that part right. But in terms of it being a big negative, at least in the near term, I think is absolutely wrong. And when I kind of go backwards, I started covering this space over 20 years ago. There was 300,000 financial advisors. Today, there's about 300,000 financial advisors. So there's the same number of advisors, yet the number of assets is up 7x. So these advisors need tools. They need technology. They need ways to do more with their customers, drive efficiency, and be more productive. And AI is an area that I think a lot of these companies are already using behind the scenes to help drive productivity, drive efficiency. And we think that'll continue. But this is a non-commoditized financial service. Fees are opaque. And it's going to take a long time to really disrupt this industry.
Well, let's keep it going. So we've seen this cascade from industry to industry, wave after wave, over the last week or so. What's the biggest thing that people are getting wrong?
Well, I just think that near term there's any impact. I actually think that it's the opposite. Like, these companies are going to make more money, not less money, using AI. And that's what they're getting wrong. I think people are just going to the lowest common denominator of AI disrupts everything, so therefore bad. And I think it's right that AI is going to change this industry over the next 10 years, 20 years, where people are going to have to use these tools, and there will be more automated advice, just like 10 years ago, 20 years ago, the robo-advisors were coming for wealth managers, and we saw zero fee compression from that. What it did is lower the bar for people to get access. And I think that's what AI will enable advisors to do, cover more clients, cover more assets, and really just have the tools they need to have that personal relationship, which I think the personal relationship is what people are willing to pay for.
You used the word commoditized, and you talked about how fees are still pretty opaque and that there's a sense that that is going to be difficult to really erode into. Isn't there a demand in an increasingly commoditized world to have more transparency, to drive down those fees, especially if there is an increasing amount of the job that can be done with a computer program?
Yeah, the way I think about it, Lisa, is that every person has different needs. So if you're covering a couple hundred clients as a financial advisor, each one of your clients has different goals, different family situation, and so what you're charging them for is different for each client. You maybe have different fee structures on different clients based on what you're doing for them, and so therefore it doesn't lend itself. These aren't fees that are put up on a billboard. They'll cover the retail brokers when they went from $9.99 to $4.99 to $0, because everybody's competing on this commoditized service. When you're working with families, you're working for their goals, for their complex lives. It's less about the fee, and it's more about the relationship and the trust and what you can do for them. So again, these are things, people are going to work with their advisors. At some point, things may change, but it's to me, this is like decades, whereas there's a lot of other areas within financial services that are going to change faster as we go to this kind of lowest common denominator.
But I guess doesn't this point to the fear that people have in the wealth management unit, but also the optimism that people have elsewhere, that if you have a greater degree of transparency, and you have a greater degree of desire for data that can then be plugged into different programs that can be far smarter than I can about exactly compiling it and giving you a narrative, it's going to cause a much faster pace of evolution. It's going to really compress some of these profit margins dramatically in a way that previous technological shifts just haven't done.
Yeah. Well, I think at the financial service level, the highest level, that is true. But you have to go through business by business. So in wealth, where you're dealing with people and you have a person involved in that, the technology itself is going to do more. It's going to provide better advice in some cases. It's going to allow advisors or without an advisor to really lower the bar for people to get access to all different types of asset and liability strategies that were reserved for family offices and the highest net worth. And I think that's going to change. But advisors are going to be able to use these tools to do more with their customers. That's on the revenue side. Think about the expense side, the back offices and all the areas of expenses these firms have where AI is already call centers and it's automating tasks that you had a lot of people doing. And we've already been seeing that. So my point is, this isn't a new concept. These companies, the largest wealth managers, Schwab, Morgan Stanley, Raymond James, they've been working on this for years. So this isn't a new concept.
Are they going to employ a lot fewer people?
So I think that over time there will be fewer people, and I think that what the technology is doing will essentially automate a lot of jobs that people have. So I think that's where you get mass efficiencies, and it really also just repositions people. So advisors, for example, a lot of advisors' jobs over time have been the manual tasks, things they don't like to do. It's order entry, it is back office that even the advisor's doing. This is going to enable them to go out, get more clients, do more with their existing clients, spend more time with them where people want to pay for that personal relationship. They want the concierge. And not everybody's going to want to pay for that. And they get the all digital experience. And they already have that today. AI will enable that. But on the full service, if you want the concierge, I think people are willing to pay a small fee for that non-commoditized relationship.
If all of these companies are employing fewer people, where does the asset growth come from?
So asset growth comes from, I guess the question is, do assets appreciate? So you go back to, I started covering the space in the early 2000s and markets are up 7x.
But they're not managing markets, they're managing people, aren't they? And people's wealth.
They're managing people's wealth, but there's an inflationary aspect to people's wealth. And also, if you go back 10, 20 years, it was about stock picking, right? Advisors were picking stocks, helping them beat the benchmark. Today, it's about all your financial, your assets, your liabilities, how many kids you have going to college, when are you trying to retire by? And that's the whole point. This is not you put it into a cookie cutter box and you get an outcome. It's everybody, you have family members sick. And so you have a lot of things that are constantly happening where people have their advisor that they've gone through a lot with. And, again, the next generation may change this big generational transfer of tens of trillions of dollars. That's going to potentially be different. That's happening over the next 3 decades. So for the next couple of decades, as long as the people are alive that have the money today and they have their trust relationship, there's a high switching cost to exiting your advisor relationship.
Forgive me for taking this to the extreme, but I think it's something we've got to think about over the long term. If fewer and fewer people are holding the assets because fewer and fewer people are being employed by these industries, isn't the government coming after a slice of all of this?
That's a whole other question, John. I mean, is the government going to look to put higher taxes on or some other type of excise, if you will, potentially in the future? But based on where we are right now, I think that this is an industry where technology is actually needed. And you would say, it's slow moving because, like I said, there's 300,000 advisors today than there were 20 years ago. But technology is going to improve the process for advisors and I think their customers and ultimately lead to better financial outcomes too. So I think the good news is, to Lisa's point, you're going to get better advice and you're going to get better products. And ultimately, advisors are going to have to do more to earn the fee that they get today.
Devin, smart. It's great to get the pushback. Appreciate it. Thank you, sir. Thank you very much. Devin Ryan there of Citizens, pushing back against some of the disruption we've seen in that sector over the past few days.
You brought up government regulation. I found a particular press release that came out earlier this morning absolutely fascinating. Anthropic coming out saying that they're donating $20 million to Public First Action, talking about how some 69% of Americans think the government is not doing enough to regulate the uses of AI. We agree. It's being adopted very quickly. You need to get on the ball and actually create regulation. So pause. A company that right now is raising billions upon billions of dollars to create AI programs that are going to potentially disrupt millions of jobs is coming out and saying to the government, please regulate us. Please explain.
What's it say at the top of the statement?
Try Claude.
There you go.
But it just it highlights, how big of a concern this is. Is this a PR move? Is this trying to get ahead of the regulation to try to influence it? Is it something to stay in the public imagination as that heat-seeking missile, as Joe Amato said, continues to go after each industry? These are the questions that this really raises, but it's fascinating that they put this out especially today.
The change is real. I'm not here to push back against that. The change is real. I don't think anyone should be naive. I do think, though, you should be eyes wide open about what's happening here. This is the roadshow for the IPO. These companies are raising a tremendous amount of money over the next 12 months. Don't wait for the opening bell. This is the roadshow. It's happening. A lot of this is marketing. Some of it's real, but a lot of it is marketing.
I'm just trying Claude, sorry. Don't mind me.
See, there you go.
I'm over here.
Breaking jobless claims up next. Matt Luzzetti will break it down over at Deutsche Bank. He's here to react from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the programme. 60 minutes away from the opening bell, seconds away from some economic data. The scores look like this going into jobless claims. Equities firmer by 0.25% on the S&P, on the Nasdaq up by 0.2%. On the Russell 2000, the small caps higher by 0.7%. In the bond market, yields repricing higher in yesterday's session following stronger than expected payrolls. This morning lower by a basis point at the front end, down by almost 3 at the very long end of the curve. 30s down to 477.89. Here's the jobless claims number, and it stays somewhat elevated relative to the previous week. 227, that is the wrong kind of upside surprise, just on the margin. Our median estimate was 223 here at Bloomberg, and the continuing claims slightly higher as well. So jobless claims coming in at 227,000. The survey was for 223, and the previous number, a revised 232. So yields stay just a little bit lower, down a basis point at the front end and down by a little more than 2 at the very long end of the curve.
Yeah, continuing claims popped up to the highest going back about a month. So that's what some people are going to be watching to get a sense of just how much people are taking a longer time getting a job. Look, this just goes to the inconclusivity of what we got yesterday. If it was such a rip-roaring labor market, why are initial jobless claims ticking up just ever so slightly week after week?
Levels versus change. Levels, the 4-week average of around 220 is not a big problem. in any way, shape or form. If you look across history, 220 is a pretty low number for jobless claims, but I'm with you, change. It has crept higher over the past few weeks, and when you compare it to the blowout payrolls report yesterday, this is why some people are poking holes in a bull case for the US economy.
And if you take a look at the revisions for the prior month, you can see that that actually was revised upward just a touch, nothing dramatic. Again, we're not raising a red flag or saying that the world's on fire. 232,000 versus 231. Nonetheless, there is a confirmation here that things are not completely rosy, which is the reason why people are saying, look, you might get some stability, but it isn't exactly a runaway labor market that's going to speak to acceleration and growth.
To weigh in on all of this, Enda Curran down in Washington, D.C. to break down the data. Enda, as Lisa pointed out, there's no big fireworks, no drama here. What stands out for you?
Maybe a little bit of a reality check, Jonathan. As you mentioned, it was expected to stabilise this reading, but it's come in a little bit above expectations. And the previous month being revised up as well suggests that, you know, the labour market softness story hasn't gone away despite yesterday's bumper number. So I would say something of a reality check. And also, by the way, I think in the wake of yesterday's numbers, there's been more focus as the day went on the revisions. Yes, the January number was strong, but the revisions for the totality of last year, as we now know, mean it was the worst hiring year outside of a recession since 2003. So that puts a lot of question marks on, is January signalling a turning point? Are we turning a corner in the labour market, that stabilisation story, or is it going to be something of a blip that will ultimately be revised back? And when you get to jobless claims this morning, as you say, they're not a game changer in and of themselves, but it's probably a reminder that the soft labour market story hasn't totally gone away.
Governor Myron responded to the strong jobs data yesterday, and he made the point that, yes, that's strong, but the reason I want to cut interest rates is because what I think is going to happen with inflation. That takes us to CPI tomorrow morning. Are you expecting to see more signs of disinflation building in this economy?
I think that's the broad expectation. I mean, Governor Myron has certainly been, a bit of an outlier, as you know, John. He's been calling for deeper rate cuts, and he's putting a lot on the fact that rental inflation will come off much faster, and he sees much faster disinflation than others do. But the inflation story tomorrow is expected to be somewhat intact. But I think there's no immediate, or at least Fed watchers don't see any immediate change on the horizon for Fed policy near term. Rates seem to be on hold. Policymakers are signalling they're comfortable with where rates are at the moment. And I think over the coming months, we're very much going to be on a wait and see, especially on the labour market front.
Enda, good to see you. Enda Curran down in Washington, D.C. We'll catch up with Enda again tomorrow when we get inflation data, 8:30 tomorrow morning. If you're just joining us, welcome. Upside surprise, as we often say with claims, the wrong kind of upside surprise, 227. The estimate in our survey, 223. That's down just a little bit from a revised 232 for the previous week. With us around the table, Matt Luzzetti of Deutsche Bank. Matt, welcome to the programme. I'm going to start with a bit of jargon. You're going to translate. What is residual seasonality? What is that? That phrase gets thrown around on Wall Street. What does that mean?
I love starting with residual seasonality on 8:30. So, we get data that comes in and it's non-seasonally adjusted. The government agencies go through this process of seasonally adjusting it. And essentially, you're trying to take out the typical seasonal patterns that you would have throughout the year. They're not able to do that perfectly. And so what you tend to see in some of these data is in different parts of the year, you have stronger data or weaker data. Over the past several years, you've seen stronger inflation data to start the year. I would add that you've actually seen stronger labor market data to start the year as well. So the upside surprise we got yesterday, we had gotten upside surprises in prior years as well. From my perspective, and I think if you translate this for the Fed, they should not get overly excited about a month or two of very strong data. They should also not get overly depressed or pessimistic about a month or two of very weak data, as you saw in the back half of last year.
So if I want a clean read, forgive me, to get a clean read on the labour market, where do I go?
That's certainly a difficulty. I think you want to be smoothing through over longer time periods. So inflation, I think there's all this focus on 3-month annualized changes. I think that's not the right measure that you want to be looking at. I think the year-over-year rate, it smooths through all the seasonal differences that we get. And so therefore, it's giving you a little bit of a better read of underlying trends in the inflation data.
And what does that say? I mean, in terms of just how much you get job growth that does stabilize at the same time that you get inflation that's starting to come down. I mean, is that picture confirmed when you smooth out the data? You take the crystal ball, you shake it up, you put a little patina on it.
Yeah.
Is that what you get?
Yeah, I want to paint a little bit of a brighter picture of the labor market data than I think we were just presenting. I think as you look at jobless claims, I think it's pretty clear that the weather has impacted those over the past 2 weeks. So last week, initial jobless claims, half of the rise was in New York, New Jersey, Pennsylvania. I think we could all relate to that being in this area, the snow that we've had. Half of the rise in continuing claims this morning, which is a week delayed, was also driven by those 3 states. So I think we're still working through some weather effects. I think as you broadly look at the labor market at this point in time, the unemployment rate has come back down to 4.3%. The quits rate, which is a very good measure of labor market slack, has basically been unchanged over the past 12 or 18 months. You have a layoff rate, which remains well below where it was before the pandemic. So you still have this somewhat uncomfortable environment of low hiring and low firing, but it's a labor market that's been pretty stable over the past 12 months.
So where is the hiring coming from, and is it good enough to sustain this? And I ask this given the fact that we're talking about wealth management potentially laying people off or not hiring people because of artificial intelligence, the fact that we've seen that roll through the tech sector. We're seeing that sort of sector by sector. How much do you start seeing that with wage pressure that really doesn't speak to this consumption boom and real acceleration backdrop that so many people are talking about?
I think that's one of the holes that people might poke in yesterday's jobs report. So you had 170,000 or so jobs added in the private sector, about 130,000 coming from education and healthcare workers. That's been the trend. You have this outside support coming from this particular sector. But I would actually add the diffusion index, which measures kind of more broadly where are we getting jobs from, picked up to a 2-year high. You saw goods producing industries actually add the most since mid-2023 yesterday. Manufacturing picked up, construction picked up. So there was some early evidence that maybe there's a broadening out of job gains that are taking place. On AI specifically, I think there's been a lot of focus on the younger age groups, that 22 to 24 age group, particularly those that are college educated. I think really importantly in the data yesterday, you saw the 20 to 24 unemployment rate. It's down 2 percentage points over the past several months, and basically hasn't risen over the past 6 or 12 months. So that was a positive development, I think, from yesterday.
You mentioned the improving breadth outside of just healthcare. Are you seeing data elsewhere that corresponds with that supports it?
I think when you look at the ISM Manufacturing Index as an example, that has shown some strength as of late. Some of the survey-based indicators have looked a little bit better, but look, it's all tentative. You don't want to kind of ring the all-clear signal here for the Fed. I think for the Fed, as we look over the next several months, yesterday's report, I think for me was strong enough where it says now if you get 1 week jobs report, that's not sufficient for them to cut rates.
The bar's higher.
The bar is now higher as you look ahead, and the market responded with that by taking out rate cuts over the next 2 meetings. The market's still building in this big premium when Kevin Warsh comes in as the Fed chair in June, that all of a sudden he's going to start cutting rates at that point.
Do you think he will?
No.
Why?
I think there's 2 things that are ongoing here. One is the reaction function of the committee, and the reaction function may be somewhat more dovish for the new Fed chair. But he's coming into a committee that, at this point, sees very good reasons, I think, to keep rates on hold. The second part of this will just be the data. The Fed has to be responding to the incoming data. And I think as you get evidence that the labor market is stabilized over the next several months, and with inflation, core PCE, which is what they're targeting, probably remaining between 2.75 and 3%, it's pretty clear from their dual mandate objectives. They're missing very clearly on one, but the labor market looks much closer on the other.
I'm thinking of what we hear, but, what about the other side of the mandate? Maybe they're not missing just as much as they have been expecting, given the fact that you see rents coming down in a significant way. McDonald's is cutting prices for value meals. Pepsi is cutting prices in order to bring in more customers. I mean, isn't there a potential disinflationary rush that we could see as early as tomorrow that could potentially give credence to some of the doves on the committee?
I think as you look ahead, there is a potential disinflationary trend that's in place. I think shelter will be key to that. One of the surprises in the last CPI print was actually that shelter and owner's equivalent rent bounced back more strongly than anticipated. So we'll have to see whether or not that continues tomorrow. I think bigger picture, we are expecting disinflation. Shelter is part of that. Core goods inflation, I think, should be part of that as well. We think tariff rates are going to come down over the course of this year, continue to come down. But the Fed has missed their inflation target by a wide margin for now 5 years. And the labor market is very close to what they think full employment is at this point in time. With that context, I think it makes a lot of sense to them be cautious about adjusting policy lower.
And yet they cut 3 times at the end of last year. And Steve Ricchiuto of Mizuho was on the program earlier suggesting that in 6 months, that will lead to another economic pickup. What's your thought on the long and variable lags? Just how long are they? How variable are they?
Yeah, I think the analysis that's done there, and for the U.S. Monetary Policy Forum, we did some work on this last year. Those long and variable lags that Milton Friedman talked about, we're kind of in year-over-year data and the cumulative effect over time. Yes, they might peak in about 18 months. When you look at the impact on quarterly data, it's pretty short. So it tends to happen over the first or second quarter. I think as you look at financial conditions today, the Fed's own metrics tell you that financial conditions are adding a percentage point to growth over the next year. That's the easiest that they've been since 2022, before they started raising rates. You have fiscal policy, which becomes more supportive over the course of this year. People worried about AI CapEx might be coming down. We're getting upside surprises from those companies there. So yes, I think the economy has a lot of support at this point.
We've seen a series of upside surprises there over the last week. Matt, it's good to see you. Thank you,
Good to
sir.
see you.
A clinic as always. Matt Luzzetti there of Deutsche Bank. Equities session highs were up by 0.4% on the S&P 500, within striking distance, not too far away from all-time highs on the S&P. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got, jobless claims coming in at 227,000. That's just an edge above estimates called for 223,000. It's a slight tick down from the previous week that saw claims revised to 232,000. Continuing claims also remaining elevated, coming in at 1.86 million. That's more than what estimates had called for. Nuveen is buying Schroders for about $13.5 billion. The acquisition is creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. It ends more than 2 centuries of independence for the UK's largest standalone asset manager, although the Schroders brand will be retained. Morgan Stanley CEO Ted Pick getting a big raise. The company boosting his pay by 32% for 2025 to $45 million after the record year for the firm. Morgan Stanley shares surged more than 40% last year, far surpassing the performance of the S&P 500. And that is your Bloomberg brief. John.
Not bad, Ted. Not bad. I know he's watching it this time,
Yeah,
so
Ted,
that's
congratulations. Buy yourself a nice bottle of champagne.
I think lunch is on you, Ted. I think that's fair to say. Coming up next on the programme, George Bory of Allspring looking ahead to tomorrow's CPI print, plus Yahaira has your morning movers. Coal stocks getting a boost from new support from the Trump administration. We're up in the pre-market there. From New York City, you're watching Bloomberg TV. The open about 44 minutes away. Equity futures session highs up by 0.4 on the S&P, higher by 0.8 on the Russell 2000. That rotation to small caps, that outperformance rather, continues. In the bond market, 2-year, 10-year, 30-year yield shaping up as follows. The 2-year down almost a basis point. No drama here. Down at the long end by 2 basis points as well on 30s to 4.78. A lot of issuance through the week, particularly across the long end of the curve, 10s and 30s.
Yesterday, we got some 10s that did not go that well, actually. We saw dealers take down a bigger proportion of the overall sale. And you saw it really cheapen up after it came to market, which raises this issue of the peripheral demand for long-end treasuries. I got to say, getting a boost today from Japan and what's going on over there. So, yes, it could be what people expect about U.S. monetary policy, but I always have one eye on what's going on with Japanese yields.
As you should. As you should. $25 billion of 30-year bonds coming to market later on this afternoon, so look out for that. As we count you down to the opening bell, let's get you some single names, some morning movers. Yahaira has more. Hey, Yahaira.
Hi, John. Big drop for Icon shares this morning, down 32% now in the pre-market after the company announced it is launching an internal accounting probe. This is a healthcare services contractor company, and it's not a small firm. It has a $10 billion market cap, but what they're saying is preliminary findings show it may have overstated revenue in 2023 and 2024 by less than 2%. While on the surface, that's not huge, it is causing some uncertainty because Icon has pulled guidance and delayed its results. Meanwhile, we are seeing Cisco shares also falling in the pre-market, down 6.25% after it became the latest company to warn us that rising memory chip prices will eat into the bottom line. That matters because Cisco, of course, is the world's largest maker of networking equipment, and it uses those components across a wide range of products, and that overshadowing what was otherwise a solid report by Cisco. And we move on to coal stocks. They are rallying in the pre-market after the Trump administration announced new support for the industry as they lean more and more on this energy source. We are seeing Peabody Energy up 4%. The White House just yesterday ordered the Pentagon to buy electricity from coal plants to power their military operations and and they announced new fundings to upgrade existing facilities. John?
Yahara, thank you. Thanks for the update. Some movers there for you going into the opening bell. Heading into the opening bell, here's the trading diary the week ahead. At 1 p.m. Eastern Time, that 30-year bond sale. Look out for that. Plus the Fed speak from Logan and Myron tomorrow. The CPI data, the last big data point going into the weekend. As we come out the other side of things, remember, long weekend here stateside. Closed on Monday for the President's Day holiday. Wednesday, we get some Fed minutes. And a week today, earnings from Walmart. The first big retailer to report. I believe Costco and Target is early March, but that's going to be an important read on this consumer and the broader economy.
Walmart has been one of the top performers over the past year, but also the past 5 years and 10 years as they morph into something of a tech company alongside a consumer spending company. Do they see the same trend that McDonald's sees? How are they catering to a low-end consumer at the same time that they're broadening their business?
Let's keep it on the data. Traders looking ahead to the latest read on inflation with CPI due tomorrow. George Bory of Allspring Global writing the following. With about $1 trillion of stimulus earmarked for the first half of 26, the US economy could overheat, leading to an uptick in inflation. George joins us now for more. George, welcome. Can you put some numbers on overheating? What does that actually look like?
Yeah, no, it's as you've just heard, we've got some mixed data. We've seen mixed data. We saw a pretty solid payroll report yesterday. But as you just mentioned, some of the retail numbers are mixed. But we know that there's a significant amount of stimulus coming into the system between tax cuts, tax refunds, tax incentives, and also, a very, very significant spend on the AI front. That clearly is underpinning the economy. Now, as you point out, there are some signs of disinflation, and we are seeing disinflation kind of gradually unfold across the economy. And this is tomorrow's print is the expectation is that, that CPI is likely to show another small notch lower. We're not convinced that can be sustained. And to the extent the strength that we're seeing in the economy does show some signs of broadening out. And while the labor market still has some pockets of weakness, we start to see a broadening there. And we see good, strong corporate profitability continuing to unfold over the course of the year. These are enough to cause both growth to expand and to broaden, as well as to keep inflation elevated. And that is one of our major concerns as we go into this year, is that there's an overwhelming consensus that disinflation is the sort of the path forward, and that it's going to be a strong and accelerating path. We don't believe that's necessarily true, and that inflation's not sticky, it's stuck. And it's the stuck nature of inflation that concerns us as bond investors.
So, George, let me jump in. Typically, for a guy like you in fixed income, when you say all those things, I would say that sounds like it's bad for treasuries and good for credit. The credit piece of it, though, is where a question mark is now, because some of the stimulus this year, some of the tailwinds are coming out of the tech sector because they're borrowing and they're spending even more. So how do you think about credit against that backdrop?
Yeah, no, credit is doing well in the aggregate. Broad inflation, sort of modest inflation, if you will. This kind of, you call it 2 3/4, 3% type of inflation, is actually a pretty healthy operating environment for the broad credit platform. So that companies are earning, pretty good profits, and their cost of funding remains fairly well contained. However, as you point out, in the tech sector, there's a significant increase in spending. There's a significant increase in borrowing. All the hyperscalers are borrowing to build out this sort of $5 to $10 trillion infrastructure spend for AI. That is coming at the expense of some credit spread widening within the sector, and then starts to rebenchmark other sectors as investors look to the alternatives. However, concentration risk does start to creep into bond investor behavior and consideration, because as the AI spend broadens out and increases, investors are being asked to lend more and more and more. And we do start to reach limits as to how much investors are willing to lend and how concentrated investors are willing to allow their portfolios to become.
And George,
this is not
a
huge
just
problem,
sorry to
but
break
it
in.
is starting to emerge.
But George, this is a problem for the investment grade side, right? When you look at some of the issuance. So you might say, okay, we'll go into high yield, go into some of the more cyclically sensitive areas. At the same time, what we're seeing there is increasing disruption risk. So which do you prefer? The concentration risk of investment grade or the potential disruption risk of high yield?
You can pick your spots. And so I think on the disruption side, you are seeing some degrees of overreaction. So our bias would be really to take advantage of those when we see sell-offs, when we see specific sectors come under pressure, and you start to see kind of weakness emerge from a credit perspective. On the funding side, you have to be very selective. There are both maturities that look attractive, but then there are also issuers that you may think have a pretty good competitive advantage from a funding perspective. So we like this volatility. Actually, it creates a lot of opportunity within our credit funds, within our investment process, and it allows you to kind of pick your spots, if you will. And so this very, very compressed, this tight spread environment is showing an increasing amount of dispersion in an otherwise overall tight environment. That's a good opportunity for us as bond investors, as active investors, to pick our spots, to align portfolios with companies that both have a competitive advantage so they can withstand or accelerate in a new AI environment, but also lend to those companies that are spending on projects and products and environments that we think have good long-term value. That's a great bond picking environment that allows you to excel. It allows you to create diversity in the portfolio and really set up your bond stream of coupons so that there's a lot of consistency as you move forward.
Hey, George, appreciate the pitch. It's good to hear from you. George Bory there of Allspring Global on the fixed income market. Losing count the amount of guests that have come on this programme in the last hour and mentioned sticky inflation for the year ahead.
And this seems to be a theme for half of the people. And then the other people say it's going to be rapid disinflation that leads to the Fed to cut rates 3 times this year.
Led by Shouter.
Which is the reason why you have this average that belies the dispersion that we're seeing under the hood.
And that's the promotional material for tomorrow morning when we count you down to CPI Friday. CPI Friday, just around the corner, 8:30 Eastern Time for that data. Coming up tomorrow, looking forward to catching up with Peter Chia of Academy Securities, Andrew Honhorst of Citi, Kelsey Barrow of JP Morgan Asset Management, and the Republican Senator Tom Tillis. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.